Guidance, and that move called a major concern by one of the brokers, Bernstein, referring to it in that way, a key transition year for that business. And Saab in the defense sector is interesting. They've come out with fourth quarter sales that beat estimates, but bear in mind this whole sector was marked down yesterday on expectations of something to come on Ukrainian peace next week in Munich.
Yeah, Munich Security Conference next week. Here we go. Friday session is almost upon us. It is time for the opening trade. Let's show you some numbers. Let's get an idea of what is happening. We are in the midst of earnings, so actually the single stocks matter maybe more than the indexes at the moment. But Europe closing at highs yesterday. We were hitting records yesterday across Europe. The FTSE 100, obviously a factor in that story. The Bank of England, what's happening with the pound, a factor into the FTSE story. So the FTSE 100 out of the gate, a little negative. We're down by 0.1%, but just 0.1%. We're, of course, waiting for payrolls a little bit later on. The IBEX is up a little bit. We're up by 0.1%. The Spanish banking story, as Chris has been mentioning, absolutely critical to that narrative. The CAC is open, but down by 0.1%. At an index level, there's not a lot happening this morning. So let's talk sectors and let's talk about what's happening with some single stocks.
Let's do it. The banking story very much in focus from an index contribution perspective. Danske Bank actually is one of your top index contributors to the upside, followed by BNP. So again, very much in focus when we talk about those moves. To the downside, though, you are seeing a lot of the biotech stocks on the back foot. From a sectoral perspective, it's absolutely showing up. The healthcare sector down by 0.8%, Anna, but gains in the banking stock sector higher by about 0.2%.
Yeah, some fairly sizable moves for these sectors. Construction materials also doing pretty well. Some of the Scandinavian names doing well on the back of that Vinci over in France, up by 2.5%. So construction and materials seems to be an area of strength in today's session. To the downside, healthcare stocks certainly under pressure, down by 0.8%. There's a mixed bag there. We've got GSK, Sanofi, AstraZeneca, all down by more than 1.5%. So that seems to be a fairly consistent theme, the pharmaceutical sector being weaker this morning.
Renault's the top gainer in the auto sector this morning. It's not up by much. We did see Nissan up circa 8% overnight on the back of the Hon Hai talk, but Renault is up 0.7%, one of only two stocks in the auto sector that is higher. Porsche is open, 911 is open, so we've got that stock down by 1.5%. That's actually not bad compared with some of the earlier calls that we saw. So Porsche is down by 1.5%. In terms of the kind of the broader picture, it's interesting to see what is on the move today. In terms of what we're seeing on the point story, L'Oreal is the second biggest points contributor to the downside. That stock is down by 3.44%.
Yeah, fascinating one, right next to Sanofi as well. So the pharma sector also taking a beating alongside L'Oreal. I just want to take a quick moment and talk about Sabadell, which is also seeing a little bit of a, nope, that's wrong. Hold on. We're going to get that numbers coming out because, of course, we know that Banco Sabadell came out with their earnings this morning. Those shares higher by 1.1%, after they announced their buybacks as well. So we're going to keep an eye on how that stock continues to trade. Let's get a broader perspective, though, and bring in Nadia Grant, head of global equities at BNP Paribas Asset Management. Nadia, pleasure to have you on the program. We thank you so much. Well, we keep kind of talking about what is driving the market trade. Is it ultimately maybe some of the buybacks, the earnings stories that we're seeing in the banking sector, among others? Is it perhaps the tariff concerns, the geopolitics? For you, what's driving the market narrative right now?
great to be here. I think it's really about the fact that you have a strong fundamental backdrop for equities. So as you said, you're in the thick of the earnings season. You're halfway through in the US. You're in the peak earnings week in the US, a third of the way through in Europe. So far, so good. So what we are seeing is that, okay, the market is expecting, or most of the economists are still expecting the US to grow towards trend. And that's a very positive backdrop for earnings growth. So you're still expecting double-digit earnings growth for the full year in the US. And so far, what you're hearing and what you've seen in Q4 is not invalidating that, is still very much in line with that. But you have, as you mentioned, the tariff uncertainty, and that obviously could put pressure on that otherwise very robust backdrop for stocks, because you're already hearing a lot on the currency become a headwinds for a lot of exporters in the US.
Well, the consensus keeps seeming to be that this tariff story is priced in. We've known about it as we saw Donald Trump even increase in some of the polls going into the election. We did see that movement happen in the markets. Is when people say tariffs are priced in or looking to price tariffs in, is it more through the currency market than through the equity market? Is that how you do it in a portfolio?
I don't think the tariff risk is priced in simply because we just do not know. So I think it's about scenario analysis. The market is a discounting mechanism, and right now, when we look at the market as a whole, it seems to discount a pretty sort of short-term shock, a pretty benign outcome. But we simply don't know whether this administration has looks at tariffs as a tool for negotiation and for them to be more of a short-term shock, and you can look through it for the equity market, or whether, on the other hand, it's really a way to rebalance federal budget and raise federal revenues, and then you could have a more meaningful impact in terms of inflationary and growth pressure, and that would have more, obviously, a material impact on your earnings picture.
So you're quite positive on the US growth side, but there are these questions around tariffs then, Nadia. What about the AI CapEx theme? Are you investing in the United States? There's been a lot of focus on that, of course. Are you investing into the AI CapEx theme, or are you a little nervous as a result of DeepSeek and pulling back on that investment theme?
We're very much invested in that sort of secular mega trend. DeepSeek was interesting in that the market initially thought that if you were going to generate a lot more efficiencies, then surely those hyperscalers wouldn't have to invest this much, these hundreds of billions of capex that they've been investing. Actually, it seems as though the cost of their model was not perhaps what it was first said it would be, and more comparable to what we have elsewhere. But more importantly, as you generate efficiencies, it's very positive for the AI themes. And you have this paradox that I had not heard about before, but was all over the news after the DeepSeek, the Jevons paradox, that actually says, as you make something more efficiency, doesn't mean that you're going to use less of it. Actually, you're going to increase usage, and actually demand for it are going to increase. So we're very much leaning towards that, but acknowledging that there's going to be it's a long upward trend, but there may be a lot of volatility on that capex, and so you may have air pockets, but really the picture of the broadening of the TAM is very constructive.
Are you leaning more into the Mag 7 then as a result? I was looking at some analysis of where we've got to on the earnings story. We've had 6 of the 7 reporting so far. The overall picture, according to Markets Live blog, earnings have been better than expected. Revenue has disappointed, though, a little bit. Are you leaning into Mag 7, or are there other ways to play that?
I like the whole supply chain. I still very much like the semi that are exposed, so those that are actually providing the infrastructure, the GPUs, so very much like that space and those custom ASIC chips. And then we're very selected in terms of which Mag 7 we actually like. But yes, along the supply chain, I think you have great opportunities.
I just need to make a little correction. Porsche is down. My bad. Very hard. I was looking at the holding company. It is down and down really aggressively. It was halted a moment ago. It is pairing some of the losses. It's still down by 4% on the back of the warning that's come out. However, Porsche takes me on to my next point, which is the DAX is having a really good year. European equities are having a really good year. I've converted this into dollars. So the DAX is up by 10.4% year to date. Okay, the S&P is up by 3.43%. Europe is massively outperforming the United States at the start of 2025. Does it continue?
I can see a scenario where it could. I can see a scenario.
There's a big pause there.
So basically, I think in January, we don't have a lot of data, right? So January tends to be a bit of a reversal month, like what has our performance.
That's why I'm asking the question, does it continue? Because normally we have this and then it doesn't continue.
Precisely. So my view is that if you just look at the fundamental with the information we have today, meaning that European earnings are going to grow 1%, they grow 1% this quarter and low single digit for the whole year versus double digit for the S&P. The economic picture is not the same. The earnings picture is not the same.
They're cheap, aren't they? Isn't that the argument? They're cheap.
But you need a catalyst.
Okay.
So, because otherwise you're cheap for a good reason.
Sure.
Right. So if you don't want to be a value trap, you need a catalyst. And I think a catalyst could be a resolution, some ceasefire.
So that could come next week?
That could.
Well, so, not the ceasefire, but the Trump plan could come next week.
That would be a catalyst. But absent a meaningful catalyst, the backdrop is not as conducive to our performance as it is in the US.
Well, that catalyst suggests that there's an overhang then in the European markets connected to say the war in Ukraine. Is that fair to say, or is there only upside change from some sort of solution, some sort of geopolitical solution?
So the way it would manifest itself would be obviously you've had manufacturing repression because of higher oil price in Europe. So you would get a revival, like you'd have the cheaper oil that would really stimulate your manufacturing footprint, and you can really see upside. That would be fundamental upside through earnings for your German manufacturers, for your chemical companies that have been suffering greatly from the conflict because of the impact of the oil price.
Porsche's halted again. We'll come back to that in a moment. Nadia, great to see you. Thank you very much indeed for coming to see us. Nadia Grant, Head of Global Equities, BNP Paribas Asset Management. Let's talk about the Core 6, show you some numbers, give you an idea of what's going on out there. There's a lot of single stocks that you need to be paying attention to. Ferrari's a little soft, which I wonder whether there's a little bit of a Porsche read across. I don't know. I'm not suggesting that is a sort of solid line, but it might be a dotted line that the market's paying attention to this morning. The AI trade fears to be back on, Schneider's back on, but ASML is weakening up a little bit. Novo's up, Farmers mixed this morning. Nestle fairly mixed as well, up by a little bit today, 0.6%. There are a lot of really interesting single stocks out there. Joe Easton, what are you watching?
So one of them really interesting guy is L'Oreal. We are seeing that stock coming down, pretty much matching the move that we saw on the US ADR yesterday. Now remember, as Anna was mentioning, a lot of that is tied to the China trading. Sales not as strong as expected, particularly among the younger markets, according to the company. But the US not looking great either in terms of the sales and the profit on that one, and we are seeing Beiersdorf coming down very slightly as well. Remember, the maker of Niveus, a little bit of a read across on that one, but L'Oreal definitely the bigger mover, down almost 4% now for that one. Then Porsche, as Guy was mentioning, in and out of a trading halt, but we have got a price on that one, so we're down 3.9% on Porsche at the moment, and there is a bit of a read across coming through into Volkswagen, given the relationship, the connections between the two companies on that one. So Porsche coming off. Remember, analysts saying they could cut their earnings estimates by around a quarter, given those weak numbers out of the company yesterday. So that one definitely a weak spot. Then in terms of those Italian banks, now not so surprising that actually the company getting taken over, Sondrio, that one is the best performing bank in Europe today. So we're up 6.5%. The takeover bid is around 4 billion euros coming from Bank BPER, and that one is the worst performer. So those stocks go in separate directions, given all that money that they'll have to pay out for the company. But it's the latest in a swathe of Italian banking M&A news that we're struggling to keep track of every day. There seems like there's something new on that. Then in terms of Danske Bank, it's the rates outlet looking really good on that one, and they are distributing a lot of that cash back to shareholders. Kind of the theme that we've seen from the Nordic lenders during this earnings season, once again benefiting from all those rising rates. So looking pretty strong on that one. Then there's a couple of defence-focused stories to focus on finally. Firstly, Saab coming off the operating profit, missing expectations, bear in mind it's one of these defence stocks that's really massively seen their multiple rise over the past couple of years, given the conflicts that we've seen, so it is only coming off a massive high. And Iveco, now this is the truck maker, the lorry maker that you see these lorries all over the street, but they've also got a part of their business that sells 4x4s to the military, and they are saying today that they're going to spin that business out, potentially separate it, and that is a surprise to the market. That's why that stock over in Italy rallying. It's the best performer on the stock 600. Iveco looking to spin out their defence business, according to a statement from the company. That one doing very well over on the Italian exchange this morning.
Thank you, Joe. Joe Easton with a rundown of some of those movers. L&G is also a mover in the UK financial services space. That stock up by 7.8% this morning, selling its US insurance entity to Meiji Yasuda. They'll get a cash consideration for this of $2.3 billion, we understand, and that basically means they can return more cash to shareholders. So there's that theme again. So they're going to be able to do an additional share buyback of £1 billion as a result of this, and the stock goes higher.
52-week high for Legal & General, 52-week high pretty much for the whole of the insurance space this morning, so they're all doing really well. A whole bunch of 52-week highs being hit. The banking sector's hitting a whole bunch of 52-week highs as well. AIB, Bank of BPM, Banco Popular, Caixa, Commerzbank, Danske, Fineco Bank, SocGen, Intesa. The list goes on. The banking sector is by far and away the best performing sector year to date. And this morning, again, there are multiple 52-week highs within that space.
One of the criticisms in the U.S. when this happens, when it's a buybacks-driven market, is that the fundamentals are void of it. But if you do start to see some of these consolidation bets actually come through at the same time that these buybacks are happening, that's where, to our previous guest's point, that's where the value creation actually happens. But then, isn't that where the biggest concern is, that those consolidation bets won't, at the end of the day, come through? So is there some sort of maybe pullback?
Yes, we can certainly talk about consolidation later this hour. We'll talk about the Danish banking sector, expand that to Europe perhaps a little as well, but consolidation relevant in both of those geographies. Coming up, let's talk about some of the things that are going on at Amazon. It's stuck between AI capacity constraints and trade policy concerns. The stock fell in after hours. We'll dig into the details there. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bloomberg Invest is back. Join me, Shonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
AI represents for sure the biggest opportunity since cloud and probably the biggest technology shift and opportunity in business since the internet. And so I think that both our business, our customers, and shareholders will be happy medium to long term that we're pursuing the capital opportunity and the business opportunity in AI.
Amazon's CEO Andy Jassy talking about the AI outlook for the business. Amazon shares fell in late trade. The weak outlook in its latest results, a factor there. The e-commerce giant warning investors that it could face capacity constraints in its cloud computing division. E-commerce, that's part of it. We'll come on to that part of it in just a moment. It is going to invest $100 billion this year in AI. Still says it's basically it's chip constrained, it's electron constrained, electricity constrained. Matt Broxham from Bloomberg Intelligence joins us now. Matt, Jassy's talking about the big investment, but he's talking about the returns being lumpy, and Amazon's always tricky to figure out. But how do I understand how efficient this investment is if the returns are going to be lumpy and all over the place? Is it easy to understand what the kind of the glide path looks like for Amazon?
No, it isn't. I guess that's why you've seen such volatility in all these big tech stocks this earnings round, because investors have got used to beat and raise every quarter, driven by cloud, and to this point, AI has been underpinning that too. And now, I mean, Amazon's cloud business is still growing very strongly, 19% year on year, but that's stabilised, and they're pointing to these kind of short-term supply constraints. So I think, the $100 billion they're going to spend mainly on AI is a big question mark. I think clearly from what Andy Jassy was saying on the conference call yesterday, he's a passionate believer in the mid to long-term opportunity that AI represents. Basically, every piece of computing technology is going to go under some kind of AI transformation, and over the long term, that's going to play out into a business that's way, way bigger than they've got today.
Talk to us about the different products that we're seeing these big tech names provide, or the similarities between them, because we've got used to companies that provide cloud also then talking about providing AI to their customers. So put it in the context of Microsoft and Google. Is this the same or different?
It's there are overlaps, but I think AWS are describing themselves. They want to be the AI supermarket, so they'll do essentially everything. So they talk about it in a kind of three-layer stack. So at the bottom, you've got the chips, and Amazon's saying you can either take our proprietary chips or NVIDIA, whatever you want, Mr. Customer, we can give it to you. If you want some models on top of that, large language models, then here we go. We've got everything for you, and I've even got DeepSeek on their platform now. If you're really not that tech savvy as a company and you want the whole thing, we've got agents that sit on top. You can take our agents, somebody else's agents. It's that complete suite of everything possible you could want. And whereas the other companies are kind of focusing more on particular parts of that stack. So I think that you're kind of there for everything from the smallest company to the biggest corporate and in between.
Okay, stay with us, Matt, because so far we have not talked about anything that's a parcel that arrives at your door, and that's another part of the Amazon business that we've known for many years. So we don't want to neglect it entirely. And that thought takes us on to something that is affecting or could affect a number of retailers in the United States, certainly, Chrissy, and that's the change in the de minimis rules that we've seen coming through from the new U.S. administration. Remind us what those are and what impact that's going to have.
Yeah, absolutely. So the de minimis rule in the United States basically is a loophole for shipping companies like Amazon that have a massive foothold in the likes of China that are actively importing some of those goods into the United States, except you don't have to pay the customs duties, the tariffs attached to it, if it's below get this, $800 until now, where Donald Trump has revoked that loophole. But just for some global context, these are some of the levels in dollars, by the way. We've currency converted these for some of the other countries around the world. The United Kingdom at $167, the European Union at about $154. Japan's the approximate number, about $60. Even Canada, that says zero, but it's actually supposed to be $15 when you convert it, of course, to American dollars. It speaks to this idea that this is a loophole that really brings that America first kind of theme to the forefront. It also affects the likes of Shein and Temu, and that was really the focus around this executive order. But like you said, Anna, it's very much affecting Amazon as well. Experts, however, saying that this may just mean that some of these companies can actually just redirect, and ultimately the consumers are going to have to pay for it.
Okay, let's join a few of the dots here then, because we've talked about Amazon, and this clearly, the change in the de minimis rules in the US could have an impact there, but it will certainly have an impact on some of the Chinese retailers that have got a foothold at the lower price point range in the United States and here in Europe. So let's talk about Chinese fast fashion retailers. Shein and Temu have been slapped with a 30% levy on US-bound goods, or that's the effect of this change in the de minimis rules. Let's bring in Andrea Felstead, who joins us from Bloomberg Opinion, to give us thoughts on this particular sector. So if we see this change in the de minimis rules in the United States, and as Kriti pointed out, they're quite, the rules were really generous to companies like Shein and Temu previously in the US. So does this completely undermine the business models of companies like Shein?
It doesn't completely undermine it. It's going to make it a lot more difficult. And they have been trying to diversify supply, but this is undoubtedly part of their business model. They say they can cope, but it's very important. So they are going to have to cope in some way. It's likely to mean higher prices to consumers. Now, if you're a brick-and-mortar retailer or a domestic US retailer in some way, this is actually very helpful because you're facing this 10% increase in tariffs from China, which I think is largely manageable. But if you do have to put your prices up, then that's going to be the fact that this de minimis rule is ending is actually going to be really helpful because you're going to face less competition from Shein and Temu. So think of the dollar stores. Dollar stores have lost a lot of business. Dollar stores largely dependent on Asia. A lot of that will be China, although everyone's diversified. You're probably one area where you're going to have to put prices up. Your consumer probably isn't able to bear it that much. But if they haven't got the option to go into Shein or Temu, that's going to make life a lot easier.
And this is really interesting in a European context as well, Guy, because plenty of European retailers have complained about, brick and mortar retailers have complained about the ability of companies like Shein to get these small parcels in without those taxes.
So you have to send them point to point. You have to send them to a person, and that's always been the kind of the deal here. And that's allowed these companies to grow really, really strongly and get round, effectively, other taxes. Andrea, does this affect Shein more than Temu? Like, Temu feels like it's trying to be Amazon. And in some ways, it can basically bring a whole load of stuff in, move it into its warehouses, and then effectively be like Amazon in terms of distribution from there. Whereas the point-to-point, business-to-person business feels like it's more of a Shein story. I wonder about the IPO then.
I think they're both. I think they're both trying to move away from the de minimis. They've sort of seen this coming for a long time. They're both trying to prepare. I think this does raise yet more questions about the Shein IPO. I mean, you know, there are loads of questions about the Shein IPO, but this was always one of the things that suddenly this could go, and you're going to have to adapt. And, you know, they are saying they are adapting, they're not dependent on it, but it will make life more difficult on top of the questions around what do you actually buy when you buy Shein? You know, it's a network. What exactly are you buying shares in? The whole questions about the supply chain. This is just another layer of concern to investors on top of the Shein IPO.
Yeah, we're going to keep an eye on that one. That's certainly some London interest in that story as well. It's going to be interesting to see how Amazon reacts as well. Amazon had thought about doing something called Amazon Hall, which was going to be basically trying to replicate this model. Maybe that goes away as well. So some big changes in this space. Guys, thank you very much indeed. Andrea Felstead from Bloomberg Opinion, Matt Bloxham from Bloomberg Intelligence. Greatly appreciated. Coming up, European companies struggling to access proper funding for growth. Therefore, they're taking their listings to the other side of the Atlantic. That's today's Big Take story. It's next. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is the opening trade. We're at 30 minutes into today's session. Seeing some marginal gains on the screen, and I do mean marginal. The DAX is the outperformer this morning, higher by 0.1%. Fairly flat on the stocks. Europe 600, the CAC 40, even the FTSE 100. I feel like, Anna, it's quite easy for me to say nothing much to report here.
Yeah, when you've got, you look up and stocks 600 is 0.01% lower. I think that's a fair assumption. But we are waiting for the jobs report, so things get exciting later. Let's also talk about what's happening in the global market story in terms of listings. Time for your Bloomberg Big Take. UK payments firm Zilch is weighing listing in the United States instead of its hometown of London. That would put it in the growing ranks of European companies chasing higher valuations over in New York, attracted by its deep financial pools and arguably its ability to price certain sectors better than here in Europe, more experience in trading them. Joining us right now is Bloomberg's Jan-Patrick Barnett, who's been working on this Big Take story. So this has been a growing theme in Europe. Certainly we talk about it a lot in the UK. Jan-Patrick, talk us through the latest here from Europe on this particular theme.
Yeah, it's a big theme, and it's growing in terms of that it's affecting more and more companies, and not just those that are thinking about like listing shares for the first time, but we have an increasingly number of established and well-known companies in Europe that are moving their listings. A good example is Linde in Germany, a chemical producer at the heart of like the core industry of Germany, and moved its listing. You have examples like software giant SAP, who rose to a record last year. And instead of headlines being like, this is great, we have a tech giant, the headlines in the local media was like, okay, when is SAP going to move its listing? So arguably, this is becoming a little bit of an existential threat to European markets, because it just feels like that more and more companies, new ones and established ones, have the feeling you can't grow here, you don't have the access to capital, there's not enough flow, there's no fair valuation for your company, and they're better placed in the US, even if their core business is and was Europe. And that's kind of something that the European leaders need to think about if they don't want to risk that European markets become even more irrelevant as they are right now.
Yeah, certainly something that's kind of an overhang on so many of these markets. What is the cure to this, what feels like a chronic problem?
There are a couple of things, and the good news here is that it seems like that the decision makers have have taken on the challenge on fixing some of the stuff. So the first one is like you need a bigger pool of liquidity. Like we have 30 primary exchanges in Europe, a dozen central clearing houses. There's way more than the streamlined process in the US. So you need to have that what's called a consolidated tape so that people have a better idea where liquidity is and that it makes it easier to trade stocks on a bigger scale. I mean, there's like silly stuff that you have companies like ASML, where the ADRs, which are listed in the US, are trading more volume every single day than their original shares in Europe. That absolutely makes no sense. Second part is like the people are working on making the bureaucracy a bit less for companies to list shares. So less paperwork, less challenges for that, so that it's easier to go into the exchange, maybe even a bit early in the process and collect that money. And then like the hardest challenge, I guess, is like you need to change the sentiment, starting from people who are putting saving money into the stock market, that they change the perception that the stock market is not a casino, but like a source for wealth generation and savings for your retirement over the long term, and that they appreciate that, and that there are great companies in Europe and that it's worth investing in Europe, and that you don't need just Apple and Amazon in your portfolio, but that there are opportunities in Europe as well. It's going to be very hard to change that sentiment, I guess, but we need to start now because the gap to the US is becoming ever wider, and some might even say it's already a little too late, but we will see. At least they are trying to make some changes.
That gap has closed since the beginning of this year, which is fascinating. JP, great story. Thank you very much indeed. My screen envy continues. Okay, let's carry on with the conversation. European stocks are outperforming and have done so far this year. The valuation gap, though, as we've just been hearing, is substantial. Joining us around the table, Matthias Stieber, Managing Director at the Investment Strategy Group over at Goldman Sachs Private Wealth Management. Nice to see you.
Thanks for having me.
Europe is closing the gap at the beginning of this year. Should I read that, and I'd be interested to get your kind of client take on this, as a sign that the diversification trade is beginning? Or is this just another head fake from Europe?
So it's interesting because the number one question we have been getting from our clients is why shouldn't they allocate 100% of their public equities to the U.S.?
Yep.
Given the extent of outperformance that we have seen in U.S. equities over the past 16 years or so, they look at those numbers and they say, given the underlying strengths of the U.S. economy, why shouldn't I allocate 100% to the U.S.? And our view is that they shouldn't do that. They should have some international diversification because we don't expect U.S. equities to continue to outperform with the frequency or at the pace that we have seen over the past 16 years. So therefore, having some international diversification continues to make a lot of sense to us.
Well, some would argue that the exposure to the European indexes is largely a play on American consumer resilience. So how do you square that?
Yeah, that is interesting. So take Germany, for instance. The economy is clearly struggling. It has not grown at all over the past 2 years. And this year we're forecasting a quite subdued expansion again. But if you look at the DAX, it's one of the best performing markets over the past couple of years. And a key reason for that is really because only 19% of DAX revenues are generated in Germany itself. So it's a very international index, and therefore you can get exposure to more the global story in Europe compared with the S&P 500, where only 28% of the revenues are generated outside the U.S., for instance.
So, Matthias, so just for me in my simple brain this Friday morning, so U.S. preeminence remains a thing or not?
We truly believe in that. So
so why diversify then, if that's the case?
No, absolutely. So first, we call appropriate diversification as the second pillar of our investment philosophy. So we truly believe in diversification. It has worked historically, and we think it will continue to do so. But if you just look at the discount at which these companies are trading relative to the U.S., it's near record highs. And you also have incredible companies that just happen to be listed outside the U.S., and we don't think that our clients should simply exclude them from their portfolios just because of that. So for all those reasons, we think having some international allocation continues to make sense, but having that overweight to the U.S. is what we recommend clients do.
The problem with diversification is that it's meant that you have underperformed. So yes, it's a good risk management tool, but in terms of the outperformance you've seen in the United States, you have underperformed if you've diversified. Does that come to an end? Yeah,
so Matthias, a client's prepared to tolerate that underperformance versus US stocks or versus the Mag 7 because they accept that they get that a little bit of underperformance perhaps, but that protects them from maybe something worse happening.
Absolutely. So even though what we have seen historically is actually that when the U.S. equity market is down 15% or more, non-US developed and emerging market equities are typically down even more. So typically on the downside, it doesn't provide that much of a hedge to the portfolio. But again, we do think there will be periods when we will see outperformance of non-US markets. The start of this year is the perfect example of that, which is why we think having some of that diversification makes sense. But I should note, we recommend that clients allocate roughly 80% of their public equities to the US.
So I'm confused now. Are European stocks good risk management tools, good diversifiers? It seems like you're basically saying that if the US goes down 10, Europe will go down 15. That doesn't sound like a great risk management tool.
I know. But if you look at the correlation historically between US equities and non-US developed equities, for instance, it's about 80%. So it's not 100%. So there are diversification benefits there. And there are episodes in the past when US equities basically traded sideways and European stocks significantly outperformed. It's just very difficult to time that really well. So as a result, we believe having that diversification structurally makes sense. But again, the overweight should be in the U.S.
So that assumes that the economic cycle, the economic expansion, which we're kind of seeing, is not uniform across the world, as in that the United States may be growing, but the rest of the world can't, but then the rest of the world may be growing while the United States slows down. So I guess my question to you here then is, to what extent can Europe grow if the United States remains steady?
Yeah, so in our central case forecast for this year, we're forecasting 1% growth for the euro area, with, again, Germany lagging behind and countries like Spain and Portugal outperforming. But the view is that to the extent that you have more export-oriented economies, in the case of Germany, they are really struggling with the downturn in the manufacturing sector, as well as their heavy reliance on both autos and China. And China has swung from being a key buyer of German goods to being a key competitor to Germany now. So that is really hurting the German economy. But to the extent that we can get changes, possibly under a new government in Germany, that could unleash more investment in the country, which is badly needed. And then when we look at Southern Europe, tourism has been a key driver of growth. The services sector continues to grow strongly, and they're benefiting from strong immigration. So that could also help the economy to grow.
Matthias, what do you? So we've talked a bit about how Europe, and Guy had a chart of this just a moment ago, and we talked to Jan Patrick. Europe has been closing the gap on the US stocks in 2025, just a little bit, and I appreciate there's only a month, but it has been, and it's not always clear why. Is it to do with front running some change in what happens in Ukraine because of the Trump administration? Do you have a sense of why Europe is doing well this year?
Yeah, we think it's a combination of cheap valuations, light investor positioning, and people trying to position for potentially positive surprises. We know that we as investors tend to focus more on what could go wrong, but of course there are many states of the world where things could go right. So to your point, European stocks could benefit from that.
Okay. Matthias Devo, Managing Director in the Investment Strategy Group at Goldman Sachs Private Wealth Management, joining us around the table this morning. We thank you so much for your time. Coming up on the program, we're going to talk about one of the stocks that, speaking about performance, has really been outperforming this morning. Danske Bank has launched a new share buyback program as their net income beats estimates. We'll be speaking exclusively to the CEO next, right here on the program. Stick with us. This is Bloomberg.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
We are in a new era of value creation and very confident that it is our scale, diversification, and the impact of our transformation which will allow us to continue to increase profits and profitability into 25 and beyond.
We think that at 13.8 of a common equity tier 1 ratio, and with our outlook in terms of earnings and performance this year, we think we'll be in a comfortable place by the end of the year.
We've stepped up our dividend. We even introduced an interim dividend to be paid in September of this year. So from that point of view, we feel that everything is on track and our platforms are delivering.
Welcome back to the programme. Some of the European banking voices there that we've been speaking to here at Bloomberg, talking about payouts to investors. Let's carry on with that theme. Danske Bank, one of the biggest gainers on the Stock 600 today. Denmark's largest lender has launched a new buyback programme. Joining us now for an exclusive conversation, Danske Bank's CEO, Carsten Egeriis. Thank you very much for joining us, Carsten. Really nice to speak to you here on Bloomberg TV. And let's start with the payout ratio. Let's talk about the amount of money that you're going to give back to shareholders. You're talking about a payout ratio of 100%, which sounds like a lot of profits, all of them. Talk to us about the rationale for paying out quite so much money to shareholders.
Yeah, first of all, thanks for having me. Well, we come out with a strong set of results today. We see top-line growth of 8%, stable costs, strong credit quality, and strong capital position. We've had a few years where we didn't pay out and distribute dividends, and today we were able to go out and follow through on the commitments that we've made to our investors when we set our new strategy back in June 2023, which was to pay out in year earnings, and that's what we do today, and I'm very pleased to be able to deliver that result.
And we see positive response in your shares today. I wonder where that leaves the M&A story for you, for the sector, Carsten. We've seen quite a big bank merger in Denmark recently. Do you expect more of that? And would you play a part in that? I mean, you're returning a lot of cash to shareholders. Are you still able to do M&A?
I think, first of all, comment on broader M&A activity. There is no question that M&A activity is picking up, I think, both in the Nordics and across Europe. I think it makes sense because the banks, the European banks, are in a better state. They're strongly capitalized. Profitability has improved significantly. Risk management, compliance has improved significantly over the years. I think regulation and so forth has stabilized more. And on the back of a requirement to invest more in technology, invest more in cyber, invest more in risk and compliance, seeing more M&A makes a lot of sense. From our perspective at Danske Bank, we have an inorganic strategy right now. We're in the first year of our what we call Forward 28 strategy plan, and we're executing on that. But we'll continue to look out if there are opportunities for us to grow inorganically as well, then we'll certainly look at the opportunities.
Carsten, it's Katie in London. I want to just very briefly bring it right back to the payouts question. I know Anna mentioned this is still one that's quite the vote of confidence, but your buybacks were less than estimated. I know certainly made up for by the dividend story. Can you just walk us through the calculus of why dividends over buybacks at a time when so many of your peers are doing the opposite?
Yeah, look, I think it's an important question, and clearly we have a dividend policy of paying out 40 to 60%. We pay out at the top of that normalized dividend policy, and then the question really is, how do you distribute the remaining 40%? It's a question that we speak with our investors about, with our board about. I think when you're trading below book value, buying back shares probably makes more sense. We are now trading, and after today, above book value. And so there is a discussion around what's the best balance between buybacks and dividends. Clearly, there is timing differences between one and the other. And given where we trade today, we felt that on the back of feedback, again, from investors and discussions with the board, that this mix would be the right one.
Can I just follow up again, morning, Guy, on this issue of returns? Can I assume that 2025 returns are going to look like 2024 returns? Is 2024 the benchmark for 25 in terms of the returns that shareholders are going to get from the bank?
Yeah, so we print a 13.4% return on equity today, and we have a target in 2026 of 13% return on equity. This year, or the 2024 earnings, was particularly driven also by very favorable impairment numbers. So we had a net release of impairments. And of course, rates were higher in 24, now coming down. So we are expecting, you could say, out to 2026, a slight decrease in return on equity, but more or less stable. So again, from 13.4% today to a target of 13% towards 26. And then in terms of total shareholder return, we have clearly said to the market that given our strong capital position today, we do expect to be able to distribute 100% of in-year earnings.
Okay. In terms of the NII picture, these numbers look better than the market was anticipated. Are we overestimating the hit that we're going to see on NII as a result of rates coming down?
I think it's an interesting question because all banks have different ways to hedge their deposit portfolio, and therefore there's a different level of volatility depending on which banks you look at. I mean, we had a strong Q4 also in terms of actual business activity, lending activity, and that has supported NII. And then in addition to that, we have a deposit hedge, which softens the downside, if you will, on interest rates coming down on NII. And clearly the offset as well, which we're expecting as we go into 25 and 26, is that we do expect that as inflation comes down and rates come down, that lending volumes, lending credit demand will pick up both on personal customers, but also in our business customer segment.
Carsten, you talk about that demand and certainly working in your favor at the moment, but there are geopolitical risks on the horizon. A lot of folks are talking about, especially in the context of Denmark being the largest Danish bank there. Walk us through any potential tariff risk to some of the household income, some of the growth forecasts that you have. How are you thinking about that, not just in terms of the U.S. relationship with Denmark, but the U.S. relationship with the EU as a whole?
Yeah, and this is, of course, a question that's really on all of our minds and all of our customers and clients' minds, and we speak with them about it daily. I think if you step back fundamentally as we look into 25, we have a view that macro growth will look like 2 to 2.5% across the Nordic countries. So slightly higher than Europe average growth. And that growth is predominantly going to be driven by an expectation that we will see increased customer demand, increased customer spending on the back of very high savings across the Nordics, on the back of real wage growth, both last year and also an expectation of that this year. So consumer spending, consumer demand supporting higher than average growth across Europe. But also when I speak with customers and clients around the Nordics, they're fairly optimistic about 2025. That said, of course, clearly a lot of uncertainty around what will happen in terms of trade war. How will that impact Europe? How will that impact different sectors? And that nervousness, of course, does potentially put some damper towards investments and how many investments and how to go about thinking 25. But still, overall, I think cautiously optimistic and a constructive picture, I think, for 25.
Carsten, very quickly, you're saying that your growth picture and the growth in Denmark is off the backs of the Nordics and the Nordic growth picture, not necessarily talking about any sort of tariff impact on the broader EU. Am I understanding that correctly?
Yeah, I mean, clearly, look, we are small open economies. So if we do see European growth being impacted significantly from a trade war, that will, of course, impact the Nordics. I think it's very unlikely looking into 2025 that any tariffs will impact the growth picture that we're seeing right now. It's very unlikely that will hit so fast. And we should remember, again, that on the back of inflation coming down and interest rates coming down, there is pent-up demand and there is a opportunity and an upside for consumer spending, supporting the economy. But having said that, of course, it is a risk if the trade wars, if the tariffs hit us harder than what we currently expect. And that is very uncertain at this stage.
All right. Danske Bank CEO Carsten Egerius joining us this morning. We thank you so much, Guy.
That stock's up 7%. Saab is down by 4%. The company's CEO there saying that 2025 is going to be hard to predict. You understand why, given what is happening with the geopolitics. The Munich Security Conference is next week. Let's talk about what we can expect at that event and what is going to come out of it. Ollie Crook joins us now from Berlin.
Yeah, listen, Guy, let's just get through these Saab numbers really quickly because I thought they were pretty interesting. Despite the fact that the stock is down about 4%, I mean, we talk organic sales growth of about 29% in the fourth quarter. Their backlog has hit yet another record of $16 billion, up 22%. And again, their sales outlook is still pretty positive, up 12 to 16%. But again, as you highlighted, I think this is worth mentioning that the CEO is saying that basically there's a lot of uncertainty on the outlook because they really don't know where that demand is going to go, if it's going to stay where it's going to be. And the other question for them is how are they going to deliver their record backlog? And this comes into the conversation that we're certainly going to be having next week at the Munich Security Conference is how do you get these defense companies to boost these kinds of volumes? This is going to be front and center. I mean, you look at the volume and you look at the revenues from Saab. I mean, they only pulled in about, close to $6 billion last year compared to, say, Lockheed Martin is closer to $70 billion. These are the sorts of things that the Europeans are contending with as they try to build out their military. And we should say that this is going to be probably one of the highest level meetings we've had yet with anybody from the Trump administration with the Europeans. We'll have J.D. Vance, we'll have Marco Rubio, and we'll have Keith Kellogg, who is really the architect and the shepherd of the relationship between the United States and trying to end the war in Ukraine and Russia. And the key thing that we're going to get next week, Guy, is going to get the unveiling of Trump's plan to European leaders, not publicly, but we're hoping to get some information on that. What does the Trump plan include? We hope to find out next week.
Going to be some great coverage coming from you, Ollie. Thank you very much indeed for bringing us that setup into that. We'll be speaking to Saab, as he says. The weekend is almost upon us. A Trump week feels like a long week. I feel like we need a weekend. They're going to be horse racing in Samoritz. Watch out for that one. That's always fun. For my weekend is the rugby. It's England versus France.
Is that even on the list, guys?
It's not. It's on my list, okay, yes. Very clearly.
Why did we not put that on the weekend teaser?
Okay.
I don't know. I think you undersold the horse racing. It's horse racing on ice.
Yeah.
Yes.
You say that like it's a normal thing.
What could possibly go wrong? I mean, we have to focus on the Super Bowl, don't we? From the sort of business of sports perspective. 124 people watch it.
124 people?
Million.
I think you may be underplaying that.
$5.5. Sorry, that's billion.
Yeah.
Ad revenue at stake. This is a big thing for live TV. The streamers haven't quite got hold of this one just yet.
The Philadelphia Eagles are really big. The Kansas City Chiefs are really cunning. I think it's going to be quite a good game. I'm not going to stay up late and watch it, but I look forward to Monday morning to being able to see the highlights.
The Kansas City Chiefs, you didn't make a Taylor Swift reference there.
Well, apparently she's driving more women to watch. So there you go. There's my serious point off a Taylor Swift reference.
Yeah. Anna
They're all serious points. They're all serious. Taylor Swift's points are all 9% serious.
9% increase in the number of women who watched the Super Bowl last year, and apparently that's all due to Taylor Swift. News you can use here at Bloomberg. 8:56 here in London. Stay with us. The business of sports continues. There'll be a special programme around the Super Bowl on the close. That's at 9 p.m. UK time. That is it for opening trade. We'll leave you with the pulse. Have a good weekend, everybody. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything.
Bloomberg Invest is back. Join me, Shonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
U.S. Treasury Secretary Scott Bessent calms markets, saying he favors a strong dollar and has no plans to change the government's debt issuance plans. Well, we'll have more from his Bloomberg interview. Amazon warns its cloud computing business cannot keep up with AI demand, despite plans to invest $100 billion this year as its outlook fails to deliver. Plus, investors tread cautiously ahead of the U.S. jobs data today, which will help show the path ahead for interest rates. While here in the U.K., investors raise bets on more cuts after the BOE downgrades its growth forecast. Now, also coming up, we'll discuss record high coffee prices with the chairman of Illy Café, Andrea Illy. That's at 9:30 a.m. UK time. But first thing is first, let's look at the markets, European markets, but also globally. A lot of the, of course, picture will depend on what happens with that jobs report. Look, I'm looking at European stocks. They're pretty much steady. Not a huge amount out there to talk about, apart from some of the earnings. And then, of course, we continue watching this trade war to see exactly what happens. If you look at some of the other things that we need to watch out for, look, Amazon.com fell in after hours trading. I'm trying to look for a pre-market. We'll get to that in a second. But it's really all about the Treasury yield. You can see U.S. 10-year yield at 4.4363. And then in general, I think the general idea is that the jobs report today may actually show that 175,000 new roles were added to the U.S. economy. But also we spoke, our Saleh Moshin spoke to Scott Bessent yesterday, and he's saying, look, he's reaching out department by department to see exactly their thoughts on the debt limit. Gold, you can see 2,866, sterling 124.66. And then finally, as we were saying, Amazon's weak guidance, disappointing investors after a pretty general positive quarter, pre-market 3.4% lower. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, investors cautiously waiting on U.S. jobs data and what it could mean for the Fed. Also taking a cautious approach is the U.S. Treasury Secretary Scott Bessent. While the Trump administration is rapidly upending much of the status quo, Bessent tells Bloomberg that he favors a strong dollar and has no plans to alter the government's debt issuance plans.
There is no tinkering with the system. They are on read-only. They are looking. They can make no changes. It is an operational program to suggest improvement. So we make 1.3 billion payments a year. And this is 2 employees who are working with a group of long-standing employees.
In just a moment, we'll turn to U.S. tech and Amazon with Matt Bloxham from Bloomberg Intelligence. But let's begin with Bloomberg's EMEA News Director, Roz Matheson, and her interview with the U.S. Treasury Secretary. Roz, there was quite a lot of interview. Soraya Moshin, of course, did that interview. I mean, she talked about debt. She talked about the markets, how he saw everything going forward. And he seemed to be reassuring to markets.
Well, that's right. As you were saying, he was trying to send a message that, he's going to be sober, careful, pragmatic. He's not going to rock the boat when it comes to things like the policy on the dollar. He's not advocating for a rapid depreciation of the dollar, and he's not going to do anything substantially different at the moment when it comes to debt. But that's in the face of what we're seeing as an awful lot of activity in this administration so far on the policy front. I mean, just blizzards of announcements and changes that are causing some unease, especially because we're seeing policies being announced by this government and then changed again very quickly, sometimes within a matter of hours. So within that, he's trying to send the message, no, I'm here and we're not going to make substantial changes. The question is, he's also got things that he needs to manage outside potentially his control. I mean, he's talking about the dollar will go here and we need this, but, there are questions around the outlook for inflation in the US, depending on things like do tariffs actually start on certain countries, and when, and what do they look like, and what's the inflationary impact of that, for example, and what about the tax policies, and do they get extended, and when, and what does that mean, both for growth and inflation? He's talking about having growth while keeping a lid on inflation, and that allowing him to be careful elsewhere, but there are a lot of unknown unknowns in all of that.
Yeah, I mean, Elon Musk is also maybe a big unknown given, how rapidly he's trying to hollow out the government. But Scott Bessent was pretty reassuring in some of the things that he wouldn't be, I think his words, tinkering with.
Well, that's right. There's been quite a lot of concern about Elon Musk and his Doge outfit going into things like the Treasury and poking around on the payment system. And again, Scott Bessent saying, no, this is read-only, to this, they can't change anything. But still, you can see that there's, potential for even friction, dare I say, there between Bessent and Musk, because how far is Musk going to end up pushing for change, not just in the Treasury, but the other arms of government, all the levels of bureaucracy, and does he want to start to make overt changes there? It's a bit unclear where that's going to end, and so you can see possibly Bessent getting a bit uncomfortable with all of that, and that relationship possibly, could it become tricky?
Yeah, so the other question, and we'll talk about Amazon in a second, some of the tech giants, Mark Zuckerberg was at the White House yesterday. Do we know what they're lobbying for or what that relationship looks like?
Well, certainly we've seen the run-up to that meeting, which was Zuckerberg also at Donald Trump's inauguration, and in recent weeks really moving quite overtly to align his business with the goals of the Trump administration. So pulling back on things like DEI goals, for example, the level of monitoring that goes on, for him as a tech company, all those kind of guardrails, and saying we don't need that anymore. And so very much getting in the right lane with Donald Trump. The question is, what does he want in return? And what he seems to want, obviously, is Donald Trump to support his company and other big tech companies against regulation. Maybe that comes very much into the European question, like let's push back against European regulation. And also he wants an environment that's conducive for AI. So he wants low regulation everywhere, and Donald Trump to help with that. And he wants help on AI.
Yep, we'll see how that goes, Ross. Thank you so much. Every day there's just a lot of news trying to get through from the White House. Ross and Matheson. Now, Amazon shares have fallen pre-market trading after a weak outlook in the lost results. The e-commerce giant warning investors that it could face capacity constraints in its cloud computing division. Now, that's despite plans to invest some $100 billion this year in AI. Now, here's Amazon Chief Executive Andy Jassy on the AI outlook for the business.
AI represents for sure the biggest opportunity since cloud, and probably the biggest technology shift and opportunity in business since the internet. And so I think that both our business, our customers, and shareholders will be happy medium to long term that we're pursuing the capital opportunity and the business opportunity in AI.
Well, joining us is Matt Bloxham from Bloomberg Intelligence. And again, Matt, I guess overlaying all of this is kind of like this political machinations are closer to Washington than we're just talking with Roz about. But what did investors not like about the Amazon results?
Yeah, what they really didn't like was the Q1 outlook, so the midpoint of the revenue range and the operating margin range, some way below consensus position. Now, the company was flagging quite big currency headwinds because of the strength of the US dollar. You kind of like to think that most analysts would have that kind of penciled in, at least into their numbers. I think there are some issues underlying that. And obviously, one of the things they pointed to was that there's huge demand for AI. They just don't have the capacity in the short term to meet it, and that's kind of slowing the ability at which they can grow AWS, the cloud business, which is still growing at 19%, which is pretty decent. And they hope that those issues will be fixed in the second half of the year on the back of this $100 billion investment. But it is going to weigh on margins. And also there is this big uncertainty around how the tariff wars, various changes in kind of shipping rules is going to impact their retail business. I think there's a bit of uncertainty perhaps from the management team about what that might do to consumer demand in the near term too.
Matt, talk to me about AI, because the strategy is very different to Microsoft or Google.
Yeah, it is. It's kind of, I guess, like the complete AI strategy. There are parts of what they're doing that are very similar to what you see at Google or Microsoft and others, but that they kind of talk about wanting to be the AI supermarket. So whatever you want, they can supply it to you. And they talk about a kind of 3-layer stack. So at the bottom, you've got the chips. So you can, if you're going to build your own models, they can provide their chips, NVIDIA chips, whatever you want. They can give you the platform. If you don't want to build your own models, they can supply those on top of that, and they've even got DeepSeek in their suite now. But if you're kind of maybe a small business and you just want an AI solution, they've got those agent models and everything else on top, so you can buy the whole end-to-end thing. And the other big tech companies provide some of that, but not necessarily all of it. So that's where this concept of being an AI supermarket comes from. And Andy Jassy yesterday was really effusive about the mid to long-term outlook of the AI opportunity, which again reflects why they're investing so much money in it this year.
So interesting, Matt. Thank you so much. As always, Matt Bloxham there from Bloomberg Intelligence. Now, coming up, investors raise bets on more UK rate cuts after the BOE downgrades its growth forecasts. Details ahead, and this is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
those of us who voted for the cut, some of whom put emphasis on uncertainty and the word careful, some of whom wanted it to be a bit more directional and wanted the word cautious instead of careful, but we chose careful in the end. And then you've got the two members who voted for a larger cut. And if you read the paragraph that comes over, they're probably in different places themselves. So don't put too much weight on the voting.
Well, that was Bank of England Governor Andrew Bailey. Now, the BOE warned that inflation will rise sharply this year and has downgraded its UK growth forecast. Now, the central bank cut rates by another 25 basis points, with 2 MPC members voting for a bumper cut. We're now joined by Hetal Mehta, head of economic research at St. James Place, and Bloomberg's Sven Ran from our MLive team. So thank you both for joining us. Hetal, let's start with you. When you look at the minutes showing a deeply divided MPC, I mean, it was really Catherine Mann that kind of made, a lot of the markets reprice. Was that a dovish statement? It didn't feel like a dovish statement. It was just the voting maybe skewed it somewhat.
Yeah, I completely agree that it was a vote that looked dovish, particularly from Catherine Mann, who'd been hawkish. She hasn't actually even voted for cuts until now, to then really flip to a 50 basis point cut. But the detail, the upward revision to inflation, the emphasis away from those 3 scenarios, shifting more towards the structural inflation, that's all pretty hawkish. But yeah, very mixed messages from the Bank of England.
Yeah, Sven, what was your reading yesterday? I also then did a fireside chat with the governor yesterday, and he says from now on it's going to be much more difficult to make monetary decisions because of all of the unknowns, internal and external.
Absolutely, Francine, because I think that the markets got initially confused by the dovish dissent from Catherine Mann. But if you look beyond the dovish dissent, there was nothing in the BOE policy report or the monetary policy report that kind of suggested they were dovish. If you look at the inflation forecast for this year, they forecast peak inflation at 3.7%, which is almost 1 percentage point higher than they were projecting earlier. And if you look at 1 year ahead inflation, i.e. first quarter of next year, they are thinking that inflation is going to be 3%. And even if you assume a real neutral rate of just 1%, which is very low, the BOE thinks it's much higher. And even if you assume it's 1%, you're arriving at a neutral nominal rate of 4%. That would imply maximum room for 2 rate cuts from here. So the markets are thinking 3 rate cuts. I don't think that's going to pan out the way the markets are thinking. The markets have consistently underestimated and overestimated how far the BOE can raise rates first and then cut rates now. So I think that the markets have got it wrong. I think we are going to get much less by way of rate cuts than the markets are thinking.
Hetal, do you agree with that? I mean, could we be at around 4% by the end of the year? And again, it does seem like the picture that was maybe painted was a bit more, stagflation. Right?
Yeah, I completely agree with the stagflation kind of narrative there, and we've been saying that for a long time. But I think, the Bank of England's got 2 problems. One, their forecasts aren't usually great. So, let's bear in mind. Yeah. So let's bear in mind that, on their forecast and on the kind of even with 2 rate cuts, that you're not getting to 2% target for quite a long time. So that would suggest, why are they even cutting at all? But we know that growth is weak. We know that we have very constrained fiscal policy. The Chancellor may or may not have to implement spending restraint, which I think will inevitably keep the Bank of England with that easing bias for sure. And I wouldn't be surprised if we saw a few more cuts.
Yeah, and then, I mean, the other concern is that, there was a big market movement in January, and that was largely gilts also reacting to what happens in the U.S. You have possible tariffs. Overall, you don't know whether that's deflationary. Again, it's very difficult to game it out. And then today we have the jobs report from the U.S. So how do you see that complex going, Sven?
Well, I think that the jobs report is going to tell us that, the U.S. economy is in pretty good shape. I mean, the jobs addition is supposed to moderate, but that's far from the guiding post for the Fed, because at the moment we've got an economy that's humming along just fine. And we had Fed's Logan say yesterday that, look, we are already butting up against the neutral rate at current levels. So we may not get too many rate cuts from the Fed this year at all. And there is a problem there, because if you look at the front end, Francine, the 2-year rate is kind of butting up against the Fed funds effective rate. That kind of suggests that the markets are kind of skeptical that the Fed will be able to show on even 1 rate cut, let alone 2 rate cuts this year.
What's your take, Hetal, on what we're expecting in the U.S. and again some of the market volatility that could maybe start in the U.S. and move elsewhere?
Yeah, so I mean, look, today's payrolls number is going to be pretty important. Powell describes the labour market as solid, but there are actually a number of maybe more technical considerations that will affect the numbers. We get the benchmark revisions, there are some population numbers changes as well. So I think the LA wildfires, all of those are going to probably create a lot of noise in the data. But overall, that cooling that we saw last year, maybe some of the revisions will make that look less pronounced, and what we've seen is that stabilisation. But with the state of kind of US government policy, economic policy, this week has felt like a very long week for those of us following, anything to do with trade wars. The direction of travel is just so unknown, and it makes it really hard for any central banker, and Fed included, to chart that clear course.
Yeah, it's true. I mean, January has felt actually like a full 12 months. There's a lot in there. Ven, I know you're also looking at the ECB. I mean, how do you think that traders may rethink basically the neutral rate implied by the ECB, or the path implied by the ECB because of that report that came out?
Yeah, I think that, the ECB is, before the pandemic, Francine, they were estimating the real neutral rate to be below zero. Now, no one thinks probably that the real rate, neutral rate, is near zero. So the report is due in a couple of hours, and I think that it will point to a range between, say, minus 25 basis points to 50 basis points, because they're usually conservative. So if they portray the rate to be, say, 0 to 50 basis points, that would be pretty hawkish. And the question really for the markets is, they're thinking that the ECB has a fair chance of going below 2% in the cycle. I don't know if the neutral rate report is going to support that argument. So that will be the crucial thing for the markets to be watching later this afternoon.
Yeah, what are you watching for? What are you expecting for in the ECB, Hetal?
I think for the ECB, the growth numbers are looking pretty dire. I really think for them, just the risk of tariffs coming their way, which is, I think, from our perspective, we've been expecting it for a long time, is difficult not to tip Europe into recession. And therefore, I think it's probably fairer that they are more aggressive in their monetary policy response.
Yeah, Ven, who do you think, has the hardest job right now amongst the big central banks in trying to tame it and frankly, keep it all together?
Well, I think that the BOE is a big challenge, because at the moment what we've got is a reprieve for global yields, because on conviction that Trump's tariffs are not going to play out. But if he imposes a tariff burden on the EU and follows through on his threat against Canada and Mexico, I think yields may go higher again. And if that happens, because the way the yields are correlated to the US securities, I think if those yields push higher, then the BOE will have a real problem, and so will Downing Street, because the headroom that Chancellor Rachel Reeves has will be eroded, and that will cause a problem for Downing Street.
Yeah, is that your biggest concern as well, Hetal?
It is a really big concern. I think the OBR is in the process of kind of finalising all of its assumptions, and there'll be a lot of back and forth between them and the Treasury, and there's very, very little wriggle room, even if there happens to be some, because yields have come down, and that's what they lock into the forecast. The growth numbers are very difficult. OBR has been quite optimistic, I think, for a very long time, and that's going to be a problem. And it just feels like there's going to be this vacuum until we get what Rachel Reeves wants, there to be only one budget a year. That's a long time to wait.
It is a long time to wait, especially if you're in the markets.
Yeah.
Hetal, thank you so much for joining us. Hetal Mehta there, Head of Economic Research at St. James Place, and Bloomberg's Ven Ram from MLive. I think I was going with the Royals there. Friday, it's been a long week. Much more to come. This is Bloomberg.
geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
the transactions,
Really a record-breaking moment.
Crypto VC is back.
and the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome back, everyone. Now let's tell you about some other stories making news. And Donald Trump has outlined plans for sweeping tax changes, including ending the carried interest tax break used by private equity and expanding the state and local tax deduction, also known as SALT. Now, the carried interest tax break allows private equity managers to pay lower rates on their earnings from investments. The tax change was not one mentioned on the campaign trail. And Bloomberg has learned that Chinese retailers on the Shein and Temu platforms have been asked to pay an additional 30% levy on goods imported to the U.S. from China and Hong Kong due to President Trump's tariff hike. Now, retailers also told Bloomberg they were worried about logistical delays in goods crossing U.S. customs. Coming up, Arabica coffee prices soar amid concerns over tight global supplies. We'll discuss all of this with Andrea Illy, the chairman of Illy Café. That's next, and this is Bloomberg.
In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like Trump to change in terms of what some people see as the over-regulation of banking in America?
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of the regulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive internationally through a more benign environment.
Nobody covers Davos like Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. The U.S. Treasury Secretary, Scott Bessent, calms markets, saying he favors a strong dollar and has no plans to change the government's debt issuance plans. We have more from his Bloomberg interview. Amazon falls on weaker outlook. It also warns its cloud computing business cannot keep up with AI demand, despite plans to invest $100 billion this year. Plus, investors tread cautiously ahead of the U.S. jobs data, which will help show the path ahead for interest rates. While the UK, investors raise bets on more cuts after the BOE downgrades its growth forecast. So, onto something that we're a bit passionate about here on The Pulse. Arabica coffee prices topped $4 per pound in New York for the first time. It comes as concerns over tight global supplies fuel a dizzying rally that doubled prices over the past year. Now, joining us now is Andrea Illy, the chairman of Illy Café. So, Andrea, thank you so much for joining us. First of all, I mean, the amount of price of Arabica beans is really pretty incredible. We look at the charts, and this could also translate even more into how much we pay for our cup of coffee. Does the rally still have room to run?
All-time records, only due to speculation. 70% of the trading is due to investors which have nothing to do with coffee and only buy it to make speculation. And in 1 month, the annual crop is being sold, just to give you the figures.
And Andrea, speculation for what? Because there's also a number of challenges,
been a trigger,
right? Yeah.
Due to meteorological adverse effects, drought in Vietnam, first in Brazil, later last year, which might cause a slight deficit in production. Traders are fighting between each other about the forecasts, because some say that the deficit will not be there. Some others say that it will be minimal. Some others say that there is a structural deficit accumulating 1/4 of the annual production over 5 or 6 years. Very, very confused. And this is made more difficult, in this case, by some, let's say, governmental situations like the deforestation law here in Europe, which has been postponed. Last minute, it was supposed to be enforced in January 1st this year. It has been postponed 1 year, but doesn't say that this is the solution to only postpone. The threat of tariffs, and also some philanthropical agencies like USAID, which were very helpful in coffee, has been turned down. So the G7 initiatives comes 3 months ago. With this declaration that supporting, promoting a public-private partnership for investing in coffee, resilience and sustainability is fantastic, and this is what we need to do.
But Andrea, when you look at the prices, and we have some great, people following this in the commodities. I mean, they tell me that my cup of coffee, could go up by 25% in price in the next 3 to 4 months. Is this a possibility?
It is possible. But in the perception of people, consumers, coffee is expensive. It is not. Because if you look at the per serving, the price of coffee is quite low in our, let's say, basket.
Yeah.
And we have to consider that with this low price, these 12.5 million micro growers, because we have to consider the statistic. 30% of the coffee is produced by only 30,000 middle large growers. The remaining 70% is produced by 12.5 million micro growers in over 40 countries. Half of them living under the poverty threshold. So how much are we going to pay the coffee? Is it a remunerative price? Is it an ethical price for the whole supply chain? So this is something we shall consider in the equation, and we shall also be aware about the value of coffee for our life. It makes you live better and longer, makes you happier, active, and healthier.
Not everyone agrees, but as an Italian, it's difficult.
There are every year another scientific studies proving that it's about longevity. And it's protective about many cancers and diabetes and cardiovascular diseases and so on.
I mean, certainly a lot of people enjoy drinking it. When you see these high prices, does it change consumer behavior? Do people drink less? Do they drink differently? Does it impact
There is a certain elasticity, which is the risk. Because now you trigger these ballooning prices. Historically, every time there has been a price peak, there has been a dramatic drop within the next 5 years. Last time the peak was $3.17. 5 years later, 40 cents per pound. And this is dramatic because it impacts on quality, it impacts on poverty, it impacts on everything. We don't want that to repeat history once again, just for short-term speculation. So this is really the time for the world coffee community stakeholders to react to this G7 solicitation to team up and invest in the coffee plantation for regenerative agriculture, which is much more resilient against meteorological effects, and also more healthier in terms of the product that you produce, and also renovating the plantation, which are too old.
And Andrea, in the more immediate term, with these very high prices, we've heard that some roasters actually are delaying getting deliveries because they thought it'd be lower. Are you hearing anything like that of roaster? I mean, is it changing anything at Illy, for example?
So the supply chain is what it is. Coffee consumptions are every day. So you need to buy coffee whenever necessary. Of course, tactically, you can try to compress your stocks for a certain period of time, but you have to buy.
So it doesn't really change radically the way. I mean, the other overlay is possible tariffs on these trade wars. Do you think coffee will be impacted?
At the moment, there are no evidences that imported green coffee in the United States to be threatened. But, some of the countries threatened by tariffs, like Mexico, Colombia, etc., are large coffee-producing countries. But I wouldn't consider this as one of the main threats.
Can I ask you, for a company like Illy, what's the biggest challenge when Arabica beans are so costly?
To maintain consistency, this is our priority. Quality, maintaining the same relationship, loyal relationship, long-term relationship with coffee growers, at the sacrificing the short-term profitability, which is a problem for all coffee companies. But then for the listed one, it reflects in the stock price. So it's just chaos.
And this is set to continue. How does this get fixed, actually, unless there is some kind
investing
of partnership?
in the coffee plantation for resilience and better agricultural practices? This is what we need to do, because we shall always remember that this trend of the meteorological impact of coffee production is consistent with a prediction that over 50% of the suitable land for coffee agriculture will be gone by 2050. So we must react, and tropical crops don't have the financial and even the institutional capacity to make the necessary investment to create resilience. We have to make the investment, governments and private sector, from mostly consuming countries, because we have a cheaper cost of money and we have an interest that these countries produce good coffee for our lives and also stay in good let's say, socio-economical conditions in their agricultural economies.
Andrea, thank you so much, as always, of course, for joining us. Andrea Illy, the chairman of Illy Café. I also need to make sure, I mean, this is not coffee. I'm Italian. I only drink espresso, so I don't want to get in trouble with anyone. Coming up, we discuss the geopolitical tensions in Gaza, Ukraine, and China with Nigel Sheinwald, the former British ambassador to the U.S. That's next, and this is Bloomberg.
Bloomberg Invest is back. Join me, Shonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
President Trump has authorized sanctions on International Criminal Court officials who investigate the U.S. and its allies. Now, that's after the court issued arrest warrants last year against the Israeli Prime Minister Benjamin Netanyahu and the nation's former defense minister over the military campaign in Gaza. Meanwhile, the president has doubled down on his vision for the Strip, reaffirming he wants the U.S. to take control. Now, let's discuss the wider diplomatic ramifications with Nigel Sheinwald, the former British ambassador to the U.S. Ambassador, thank you for joining us. There's the news flow, I have to say, over the last 2 weeks has been pretty terrific. What were you able to understand about what U.S. policy in the Middle East will be?
Well, it has been a whirlwind, and I think everyone watching this from outside the U.S. Understands that policy is moving fast and breaking things. It's also failing fast because quite a few of the things which have been announced over the last 18 days, some of them have been reversed immediately or changed pretty radically. So I don't think we know yet. It clearly hasn't settled down. Perhaps it never will. And the Gaza plan was perhaps the case in point, in the sense that people around the world were scratching their heads. I think Benjamin Netanyahu himself said that jaws were dropping. And I don't think it makes better sense today than when it was announced a few days ago. And the questions people are asking are much more about the short term in Gaza and the Middle East. We're only on phase one of that ceasefire deal. We need to get to phase two and the continuation of the release of the hostages and the stabilization of the position and continuing to get aid in. Those are the key things. And of course, President Trump may have a vision for a future Gaza. It's not clear how he gets there. It's not clear he's got regional buy-in or local buy-in for it. So I think we're a long way away from a plan. We may have a sort of half a vision, but this, it doesn't move the dial in terms of practical Middle Eastern politics yet.
Yeah, what does it mean for the region? If you look at some of the allies, when you look at Saudi Arabia and others, how are they going to react to this? It's quite unclear when allies, maybe former allies, deal with the new people in the White House and the new administration, what the right way to react is.
Well, I think you have to start deeper conversations, and I think that there have been hints from Marco Rubio, the Secretary of State, during the week, of a discussion going on, frankly, within the U.S. administration about how this can be turned into something concrete. And there are elements of it. Plainly, the reconstruction of Gaza is going to be a huge effort and an international effort. And if the U.S. wants to get involved in a significant way, and the president, with his knowledge of the real estate business, can obviously play a huge part there, then I'm sure that in principle is to be welcomed. But the idea that extending the McKinley doctrine of a century and a quarter ago to taking scraps of land around the world at will, that doesn't make sense today, even with the huge power of the United States behind it. And it contradicts one of President Trump's key ideas, which is the US shouldn't get itself involved militarily and excessively financially around the world. We don't want American retrenchment, but neither do we want America sort of lashing out internationally and trying to grab parts of the world. I'm sure that ultimately isn't his intention, but it clearly can't work without the expense of lives and resources for the United States, which he doesn't want and has been trying over both his presidencies to avoid. So there are some inner contradictions here. I think it requires much more discussion. But I think also the Netanyahu visit to Washington this week, in a sense, did let Israel off the hook. I mean, they need to be active participants in a discussion about what next after this very early stage of the ceasefire, which thankfully has been holding. Once that comes to an end, we need to move on and have very practical ideas for how Gaza is to be administered while the second phase gets going.
What do you think the tariffs are for? It's still unclear whether, part of it is just to get revenue in the country, or is it really 100% a negotiating tactic to get something else done?
I think it creates a mood around the world where people are prepared to think about really random, asymmetrical types of deals. I've heard talk of Ukrainian rare earths in return for American military support. And there's a sense, in which other countries which desperately need American involvement and support, they will think about those quite creative and exotic trades. So I think it softens people up for a transactional world in which pretty much everything is on the table. And there is a sense in which that's not necessarily a bad thing. But there's no doubt in my mind that the majority of economists, the majority of political analysts think that the threat of tariffs in itself has an unsettling and damaging effect on world trade and the world economy. And certainly that American consumers and American producers won't, be magically let off if this tariff war increases and we get into real trade battles and confrontations around the world. So I think there may be some calculation in what the president's doing. For the most part, I think it's still his lifelong belief in tariffs, his belief that it helps the revenue situation of the U.S. exchequer. And his belief that negotiation is a great thing and that this can soften people up for it.
I mean, I guess the concern is that, more than negotiation, that the president sees as a zero-sum game, so that he has to win, and that puts allies in a very difficult position. Ambassador, how do you think the UK-US relationship will look like this year?
Well, I think it's going to come under some pressure, inevitably. The US is one of the United States' absolutely key allies. You've got the Japanese Prime Minister coming to Washington as the second of President Trump's visitors. I'm sure Keir Starmer will be following shortly. We have a new ambassador arriving in Washington as well. So look, there are some fundamentals in the UK-US relationship, which I don't think will change rapidly. But clearly, on Ukraine, on NATO, on tariffs, on handling the Middle East situation, the UK has interests as well and has views which it will want to get across to the administration, and that is going to be difficult for us as allies. I think getting across to the president that alliances aren't just there for talk about liberal values and the law and all those abstract things. They are there to ensure the protection of our countries, the security of our countries, and America gets something out of that, and American businesses get something out of the stability and the predictability which alliances create. So in his first term, there was a lot of talk about NATO, but NATO is still here today. European countries are contributing 30% more than they were 3 years ago to defense expenditure. So I think this is a different situation from the one he inherited in 2017. I hope you'll see the differences. And at the Munich conference next week, a very important moment where Europeans will start to see the color of the Trump administration's money in relation to Ukraine, and they will be hoping that at the end of it, America puts more pressure on Russia as the aggressor in this than they put on their allies in NATO and their partners in Ukraine.
Nigel Scheinfeld, thank you so much for joining us, the former British ambassador to the U.S. And, of course, we'll have full coverage of the Munich Security Conference starting next Friday. Coming up, the U.S. Treasury Secretary Scott Bessent tells Bloomberg Elon Musk's team are not tinkering with any Treasury payment systems. More from our interview next, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
U.S. Treasury Secretary Scott Bessent has told us Elon Musk's team are not tinkering with any Treasury or IRS payment system. Now, he also spoke to Saleh about his concerns with the IRS in regards to its privacy, collections, and robustness.
These are Treasury employees. It is 2 Treasury employees, one of whom I personally interviewed in his final round. There is no tinkering with the system. They are on read-only. They are looking. They can make no changes. It is an operational program to suggest improvement. So we make 1.3 billion payments a year. And this is 2 employees who are working with a group of long-standing employees.
The letter that the Treasury Department sent earlier this week talked about how the team currently does not have access to change the system. Have they at any point this year had the ability to make changes?
Absolutely not. This is no different than you would have at a private company. And by the way, the ability to change the system sits over at the Federal Reserve. So it doesn't even lie in this building. So they could make suggestions on how to change the system, but we don't even run the system.
And if they ask for, if they request the ability to change the system, would you grant that?
No, again, they have no ability to change the system. I have no ability to grant that change. That they can make suggestions, then it would go to the Federal Reserve, and just like any large ERP system, there would be tests, there would be this, there would be that, and then the Fed will determine whether these changes are robust or not.
As the Secretary of Treasury, you also oversee the IRS. Do you know what kind of access the team has to IRS data or individual taxpayer data?
Well, I'm glad you asked that too, because look, the IRS, the privacy issue is one of the biggest issues. And over the past 4 years, we've seen a lot of leaks out of there. The IRS systems are quite poor. When I started in college in 1980, I learned the program in COBOL. I think there are 12 different systems at the IRS that still run on COBOL. But as of now, there is no engagement at the IRS.
And if they request that access, would you sign off on that request?
They haven't, so we'll take that when it comes to it. I think there is a lot to do there, but the president was elected with a big agenda, and to the extent that getting the IRS in better shape is part of that, sure. Because look, with the IRS, what am I concerned about? I am concerned about collections, I'm concerned about privacy, and I'm concerned that the system is robust.
U.S. Treasury Secretary Scott Bessent speaking to Bloomberg's Saleha Moshin. Up next, Bloomberg Brief, Manus Karani in New York, and this is Bloomberg. Happy Jobs Day, everyone.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
what's the best piece of advice you would give to someone young who wants to make a difference, actually, in this world? In architecture or with something else?
Wow. I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Good morning from our global headquarters in New York. I'm Manus Craney. You're welcome to Bloomberg Brief. Let's set that agenda. Revisions in focus. Investors brace for the latest jobs report as Laurie Logan suggests rates may already be close to neutral. Can't keep up. Amazon joins big tech in warning capacity constraints endure in their voyage to meet AI demand. And Treasury Secretary Scott Bessent attempts to calm markets with his stance on a strong dollar policy and the debt plans. Good morning to you. It's Jobs Day. The whisper number on the Bloomberg terminal, 196,000. Consensus, 175. Flat on the NASDAQ. We'll talk more about the individual movers there in a moment. We're almost priced to perfection is the narrative from Goldman Sachs, and Bank of America have got the flow show out. $600 million left U.S. equities in the week to the 5th of February. So we're counting down to the jobs number. Cash and bonds, they attracted the bulk of the inflows. And I want to take you to the bond market. This is important. 443, you're down 10 basis points on the week. The bond market has been falling in yield for 4 weeks in a row. You have not seen that since 2021. And 10-year bonds closed below the Fed funds for the first time this year. As Scott Bessent gave a very clear message on day 2 in his outing. We are here to control the yield curve, and the path to that is via energy and the Doge Committee, on which he says we are very aligned, Elon Musk and himself. Alignment. We're also keeping an eye on a couple of other stocks for you. Pinterest surging. They posted strong holiday quarter revenue and gave an upbeat forecast on the sales for the current period. Expedia also soaring after the online travel agency posted better than expected gross bookings during the winter and reinstated the quarterly dividend. Porsche dropping to a record low after the sports car maker said it'll take a hit of more than $800 million linked to revamping its lineup this year. Brutal. In just a few moments, Max Kettner joins me from HSBC. Later in the hour, Citi's Veronica Trump sets the non-farm payroll table, and an exclusive interview with the ECB Governing Council member Boris Vujicic. That's a little bit later in the show. Max Kettner joins me. He is the Chief Multi-Asset Strategist over at HSBC. Max, good to have you with us on Jobs Day. You last put out your big note. It was pretty big headline. Goldilocks on steroids. We've had a number of disruptive moments, from the revelations of DeepSeek to the tariff narrative. Does that uber bullish stance challenged in any way, or do you remain 100% convicted to it?
Oh, it's 110%. I think, if anything, when we look at the last 2 weeks, it's incredible what's been thrown at the market in the last 2 weeks. We started with the AI traders over, and it was all about some of the Magnificent Seven disappointing overnight. We've got Amazon as well. We had Alphabet, we had Microsoft allegedly with really negative surprises. We obviously had the concerns around tariffs. Now, all of that in the last 2 weeks. And what happens? The S&P is flat. Right? It's flat. It's genuinely just flat. Nothing's happened. High yield spreads have tightened. Emerging market debt spreads have tightened. Investment grade spreads are flat. So frankly, for the amount of really bad things, of bad stuff that's been thrown at the market in the last 10 trading sessions or last 9 trading sessions, it's been incredible. It's actually, if that is the worst reaction, then bring it on. I'll take it every day. In reality, you've just mentioned it. We've just seen funds. We've just seen money leaving U.S. equities. We've seen, when we look at some of the sentiment surveys, the AAII bull-bear spread is a net bearish again. And again, despite prices not having changed. How can I be, how can it be bearish at all? How can I not look at that and be like, it's as Goldilocks as it can get?
So if you want to bring it on then, is part of the thesis, when I was running through the markets, bonds, down for 10 basis points this week, down for 4 weeks in a row. We haven't seen that since 2021. This is something very strange given the tariff narrative versus the shift lower in the 10s. Does that add to your 110% bullishness? Bring it on.
Well, now it makes it 120, Manus.
I guess, we're going up. It's a fast market in your bullishness, Max. Good morning.
So I guess, when we look at it when we look at all the things that have been thrown at the market in the last 2 weeks, I think actually people have been focusing on the wrong thing. The main thing that's really, really changed over the last 2 weeks compared to the concerns in Q4 was around fiscal, was around the yield curve, was around issuance at the long end. For all the talk around tariff, around what the new US president is going to do, what's happening with DeepSeek and AI. Actually, I would argue the last 2 weeks, the main thing that's happened was Scott Bessent with the quarterly refunding announcement. Remember in November, he was saying, oh, you know what? I really don't like what Janet Yellen's been doing. She's been overpaying by issuing at the front end, and we should be extending maturities much, much more. We should be issuing much more in the long end. And the reality now is he's been telling us, and the Treasury has been telling us, actually for at least the next several quarters, the issuance pattern is going to remain the same. And that is super bullish. It's bullish for the long end. It's bullish for long end yields. It should mean flatter curves. It should actually, particularly given that we think in the next 4 months, underlying inflation, super core inflation in the US can come down really quite significantly in the next 4 months, the January to April period. That should help as well. And as the long end comes down, that helps everything. It helps even emerging market asset classes, from equities to rates and to credit.
So this drop in the yield, as you say, underpinned by Scott Bessent, do you become even more bullish then when you hear about this channeling of alignment on energy and the Doge committee that he made not the Doge committee, but the head of Doge, which is Elon Musk? That's even more convincing, isn't it?
Yeah, I would, however, say it's mostly to do with oil. So we, in our tactical asset allocation view, we are really significantly underweight in oil and overweight in gold. But we've been underweight in oil now for the last 3 weeks after that spike that we had at the end of last year and the beginning of this year, simply because, that front-end driven spike in oil that was driven by cold weather, you guys know it in New York, by cold weather, by this squeeze in inventories and the latest sanctions by the old US administration. All of that should really prove temporary, and we're seeing that already. So oil down back to 70, maybe even temporarily below 70, all of that actually adds to the Goldilocks narrative. It adds to the narrative that inflation expectations, particularly at the front end right now, are too high. But even at the long end, when we look at the divergence that we've seen between inflation expectations, break-evens, and oil prices, that can come down as now those concerns around more issuance at the long end are really, really reduced. And then that means term premium, that increase in the term premium we've seen since September is really a bit overdone. And all of that really, really helps that Goldilocks narrative.
Okay, so Goldilocks endures. You want to be long risk. At any margin, is there a risk to growth because of this narrative around boomerang or retaliatory tariffs as and when we go through this tariff phase? That is a real risk, Max, that everybody else in the market is talking about. How prescient is that for you?
I think, however, Manus, when we think about it over the last 2.5 years, that's been genuinely the big risk over the last 2.5 years. Since Q3 2023, really, or 2022, sorry, so for the last 10 quarters, really, consensus has been constantly talking about these long and variable lags, which frankly, I still don't understand what they mean. It's kind of like, well, you know, so far we've been wrong, but give us time, and at some point growth is going to go down. What that does is it keeps consensus expectations, growth expectations, relatively low. Now that's changed now. That's changed for the first time in 2.5 years, where consensus expectations, when you guys look at the Bloomberg terminal, at these Bloomberg consensus expectations, they're 2% plus for the next few quarters. So I am with you that at some point, maybe this year, those higher growth expectations now, they could be started to be disappointed. But why not yet? Why is that not a story for the next, call it 5 months, not for H1? Because as we see data only coming in line, not surprising so much to the upside again, and maybe even a tad surprising to the downside, that takes out that tail risk of a rate hike, you know, maybe even this year or H1 2026. And as we take out more and more of that tail risk, again, that adds to the Goldilocks narrative. So it is one, I would say it's maybe one for H2 25. It's not one for the next 6 months.
The other big story that we've got is obviously from the DeepSeek story, and that is this renewed bullishness on China tech. I mean, you look at the Hang Seng, it is flying higher. Does this play into your let's say, go beyond US exceptionalism and look for opportunities? To what extent can China actually deliver in the face of tariffs? Because if they do more stimulus, that is a bullish story. Tech is lit up because of DeepSeek.
Yeah, I think China is still a buy here on the equity side. I think emerging market equities are a buy. It's not just the tariff and not just the DeepSeek story, but of course, China internet looks really, really attractive if indeed the AI story is broadening out from purely CapEx, so from purely AI spending, to broadening out to the AI enablers, so to those companies that actually have to spend the CapEx, and that so far, particularly last year, we've had sort of those concerns in the market around, oh, you know what, can they really make money of it? There was all these constant concerns around monetization. Those guys should actually then benefit. So I would say 100% with you, it's going to broaden out a bit away from purely AI infrastructure, purely AI CapEx beneficiaries, to more the AI enablers. And that's good. But let's not forget, what we heard from most of the Mag 7 over the last 2 weeks has been nothing at all around, oh yeah, we're going to dramatically cut spending. No. So even that story is still very much alive.
No, we're very much up there in over 250 billion for the year. Your enthusiasm, your bullishness is infectious. Max, thank you very much. On Jobs Day, Max Kettner there from HSBC. Other stories trending on your Bloomberg terminal. This is what we've got for you. Shares of Nissan climbing as Foxconn reportedly making another pass at the car maker as its tie-up with Honda falls apart. Now, it backed off in December after the deal was penned to bring both brands under a single holding company. Honda and Nissan confirmed this week that they're still discussing various options, including the possibility of ending negotiations. BYD shares are on track for their best week since 2020. Investors await the autopilot update. It will showcase progress on the system and introduce more intelligence features at its low-priced cars at an event scheduled on Monday. Now, any significant breakthrough in its technologies will intensify the competition in China's EV market. Now, a plane carrying 10 people went missing in rural Alaska on Thursday during bad weather. According to Alaska's Department of Public Safety, the Bering Air flight was headed to Nome with 9 passengers and a pilot on board. The Associated Press reported that rescue crews are scouring the ground for any signs of the wreckage of the jet.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
the transactions,
Really a record-breaking moment.
Crypto VC is back.
and the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bloomberg Brief. I'm Manny Screeney in New York. Amazon shares falling in the pre-market trade after weaker than expected outlook. The e-commerce giant was warning investors it could face capacity constraints in its cloud computing division. That's despite the plans to invest more than $100 billion in AI this year. Matt Bloxham is with me to go through this. Matt, you look at Andy Jassy, the CEO, saying it's going to be a lumpy year. You walk away from this week, and all of them, Amazon, Microsoft, and Alphabet, all talking about constraints. What is Amazon's constraint in the cloud?
How much data center capacity they've got, which is the same with everybody else, and the constraints about how quickly they can bring that on, or how quickly they can get hands on NVIDIA chips, how quickly they can manufacture their own chips, and how quickly they can get power supply into the data center capacity that they have. And so that's what this $100 billion CapEx is there to try and help them fix this year. I think there's not too much they can do in the short term about the chip supply chain, but they can certainly spend money to build more physical data centers and get power delivered to them. So I think they indicated on the call yesterday that they hope that the second half, the capacity issues will kind of ease, and that the lumpiness might start to smooth out a bit from there.
So this is about the monetization. This is about the belief in the monetization and the usage. I was looking at Deutsche Bank this morning. Great line from Mr. Reed over at Deutsche Bank. It's like the telcos in 1999, 2000 with 3G licenses, but without the debt. So long as the demand carries through, and that is the big caveat, isn't it? It's the monetization of that demand.
Yeah, it is, and Andy Jassy very optimistic about the outlook for AI, and essentially saying every single compute process and application in the future is going to have to be reimagined with AI at the center of it. So that's kind of what's really fueling their investments. As you say, there are some similarities to the 3G. Back then, I can remember doing all sorts of models on how valuable those 3G licenses were or weren't, and it is about the applications in the future and how much people are going to pay for these things, and that is still very much a big question mark. I think the difference here is that there is clearly, even without AI, a huge amount of cloud demand, and you can bring this data center capex through in a quite modular way. So if demand starts to wane, they probably can slow down that capex investment, perhaps not this year, but in years to come. And these data centers, will last 30, 40 years. So, that there is some management of the risk here, I think.
Well, those hyperscalers are going to spend $280 billion this year on CapEx. Let's talk about Apple, constantly lambasted for not having freshened up their lineup, but it looks like they're going to go for the lower end, a new model in the lower end, and this is about defending market share and indeed perhaps maybe even winning some back.
That's right, yeah. So a refresh, I think, of the kind of the low end, and possibly even a thinner model coming later in the year. So I think that's really important for them, given I think the iPhone 16 demand's been a bit lackluster. I think it also potentially helps them in some of the emerging markets, like, for example, India, where you do need a lower price point. I think the Apple brand has huge global appeal, but the price point out of reach for lots of people. So a cheaper phone, not just lower segments in developed markets, but some of these emerging markets where there's huge potential could help them to build their market share position.
Matt, thank you very much. Let's see when that new shape and style comes to the market. Matt Bloxham there. Coming up, Secretary Bessent strikes a cautious tone. More on the conversation on Bloomberg. That's next.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
First of all, the strong dollar policy is completely intact with President Trump, and I was very happy at his Economic Club of New York speech in August when he re-emphasized the importance of maintaining the dollar reserve currency status. What we are focused on is lowering rates. So we are less focused on the specific of rate cuts and how do we get the whole curve down. I mentioned that the 10-year, I believe, is the important price to focus on. It's mortgages, it's long-term capital formation.
U.S. Treasury Secretary Scott Bessent, though, speaking to Bloomberg yesterday. Let's unpack what we learned from that interview. Joshua Galoo is with me. Josh, the sense here was a message of control of systems, a control of the bond market, and very much alignment with the external, which is Elon Musk and Doge.
That's right. He clearly had a message that was meant to calm any
the tumult that has come out of the administration so far, specifically around the Elon Musk and his Department of Government Efficiency. There have been reports, obviously, that they're going through, that his workers are going through Treasury payment systems and looking for inefficiencies and waste. And Bessent wanted to clarify that they do not have control of the payment systems. They cannot unilaterally stop payments. All of that runs through the systems, run through the Fed. I think that had a calming effect, although it probably does little to calm the politics of the situation, where many Democrats, probably the entire party, and also quite a few Republicans are concerned about privacy, about the amount of power that Musk has amassed in the administration, and a unit that he is in charge of that isn't clear in terms of what the accountability for that is. So Bessent, though, he struck a tone not only of trying to calm some concerns around that group, but also took a stab at another thing that's very dear to Trump. In his first administration, he spent a lot of time lambasting the Fed for keeping interest rates too high, and also for not tamping out inflation at the beginning of the pandemic. But he said that this administration, and he certainly will not be commenting on monetary policy. He's going to stay out of it. He thinks Jerome Powell, whom he met with recently, is going to make the right decisions. And Bessent and the administration are more concerned about longer-term rates, the 10-year Treasury, specifically, that is more tied to mortgages, long-term capital formation, things that Trump will certainly need to get right, given some of his other policies like tax breaks.
And he certainly went on to say about Doge, which is this is not a roving band running around. These are trained professionals. So I think he really sort of tried to reassure on that. We understand the president, Donald Trump, had a meeting with the Republican lawmakers. Now, this is about upping what he's going to put into the tax deal, but how he's going to pay for it. And time immemorial has talked about, pulling carried interest. But what is really on the table to help pay for the SALT tax deduction being raised?
Well, like you said, ending the carried interest break. I mean, that's certainly one thing that is going to get the most attention in terms of on the Hill, where the fights are going to happen, because this, as you mentioned, this has come up forever as a potential way to save, and it gets fought. Any changes to that face fierce resistance from private equity managers, venture capital, in terms of how that money is taxed. So, it remains to be seen whether they can strike a deal on that. But in terms of other payments, he wants to also end taxes on tips, Social Security, that sort of thing. These are going to be things that speak to certain parts of his base politically, and in order to get this passed, he is going to, at least Speaker Johnson is talking about wrapping this together with an immigration bill, which is going to make it harder for dissenting Republicans to defect.
Of course, the one big, beautiful bill. Josh, thank you very much. The debate in Washington. Joshua Galou there on the very latest. We are counting down to your jobs report. City's Veronica Clark is joining me next around the desk, right here on Bloomberg.
in 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
From our global headquarters in New York, you're welcome to Bloomberg Brief. I'm Menace Crenny. Let's set your agenda. Revisions in focus. Investors brace for the latest jobs report as Laurie Logan suggests rates may already be close to neutral. Can't keep up. Amazon joins big tech in warning capacity constraints to meet AI demand. And don't miss our exclusive interview with the ECB Governing Council member, Boris Vojcic. That's coming up. Markets, it's jobs day. Whisper number at the moment is 197,000. It's gone up by another 1,000 since 5 a.m. Stocks are flat at the moment. We'll talk about the tech stocks in just a moment. 61.06. Prepare for a 1% swing. We just had Max Kettner from HSBC. He is unequivocally 110% bullish. And for him, it really is about the flow of money. By the way, $600 million left equities last week on the Bank of America flow show. Roll it over. Have a look at the bond market. This is where it gets crunchy. Bonds trade at 443. It's the first time that 10-year government bonds are below the Fed funds in 2025. We're down 10 basis points on the week. We're down for 4 weeks in a row on 10-year government bond yields. You haven't seen that since 2021. Scott Bessent, it really does confirm about the long end and no change in issuance. That is driving this narrative, along with the desire to control the longer end of the curve, to control the whole curve, to be pretty precise. Those are your bond markets. Let's see how they react on the back of the jobs number. As I say, the consensus number estimate is 175,000 of an ad for January. Keeping a close eye on those yearly revisions. Veronica Clark is with me around the desk here this morning. Veronica, good to see you. You're going for, it's the first time in a long time, actually. You and the whisper number, you're moving into natural alignment, but stability would be the byword for you.
Yeah, I mean, we definitely have seen this surprising stability in the labor market, at least surprising to us in the last 6 months or so. You know, we were definitely, understood the weakening that we saw over the summer and expected that to continue. And it does seem like there's some more stability. And yeah, we're expecting 195,000 jobs today. I would still say, though, that there is a lot that makes us uncomfortable about that stability. In a lot of ways, this doesn't necessarily look like a healthy labor market. We still see the hiring rate very low. But there are well-known seasonal adjustment issues with this January number. Maybe we don't see that weakness until the spring.
You've been saying this consistently month after month.
Yeah.
And yet this data has yet to, somebody's out of sync. The data has yet to catch up with you, or you've yet to catch up with a shifting narrative.
Yeah, I mean, certainly if the data are proving us wrong, we want to admit that. But I haven't seen anything change in the fundamentals of how businesses and how consumers are viewing the labor market. We still see essentially it's a very low churn labor market. We don't see the big layoffs, but we also see the hiring rate very low. We also see quit rates very low. People don't feel good about the labor market. Businesses aren't hiring. And I wonder if there are these seasonal issues where it's really in the spring and summer when you would expect businesses to be hiring, and that's the time of year, the last couple years, that we've seen that unemployment rate rising. So I do worry that as we get to the spring and hiring is still low, we'll see that weakness again.
The DOGE is active, and the offer is out there to federal employees to sign up for early retirement. We understand the number is 50,000. What kind of number shifts the dial at that in that narrative for the unemployment report?
Yeah, there are a lot of uncertainties surrounding federal employment right now. Questions on the timing of when we would see that in the data. Maybe we really don't see it until later in the year. But I think if you were getting to 100,000, 200,000, yeah, you would certainly see that in the data. And I don't necessarily believe that this is a healthy labor market that people will be quickly finding jobs in. We see that in, if you do get laid off, it's taking you longer to find work.
So is my bargaining power for wages lower?
Yeah, and I think we've seen that.
And is that coming through in the data? The ECI has slipped.
Yeah, exactly. I think we have seen wage growth slowing. The Atlanta Fed does a helpful breakdown of wages by different types of workers, and you definitely see wages for people who are switching jobs that have come down a lot. There is still some stickiness if you stayed in your job. Maybe your wage is catching up to a higher market wage over the last couple of years, but it does seem like demand for new workers, those workers are not getting the big wage bumps anymore.
So do we drift in this 4 to 4.3? What is it that breaks us out of that cycle that then has got a consequence for the Fed?
Yeah, I really worry as we get to the spring, and if hiring is still very low, maybe we get an animal spirits optimism induced increase in hiring, although on the other hand, maybe tariffs and policy uncertainty has businesses pulling back a bit more. I would worry as we get to the spring, we could see numbers like 4.4%, 4.5%, and that on the unemployment rate, the Fed would get much more concerned, I think.
We are debating when tariffs actually go live. They still haven't gone live yet. Technically, there's still a couple of days for China. Are you a believer in a material growth shock?
Yeah, I don't think so.
To the U.S., I should say, in the first instance.
Yeah, I don't think so. I think we probably will see is eventually when we get some kind of, details on a reconciliation bill, maybe we do see corporate taxes, cut a bit more to help offset that. And so far, a 10% tariff, that's not nothing, but I think that's manageable. Certainly if we were to get 25% on Canada and Mexico, we'll come back to that in March, that I think would be a much more material growth shock.
And this is what the Fed has got to grapple with, isn't it? So let's just listen to what Laurie Logan had to say yesterday.
On-target inflation alongside 2 quarters of stability in the labor market and demand would strongly suggest that we're already pretty close to the neutral rate without much near-term room for further cuts.
That's an interesting shout from Laurie Logan. We're almost pretty much at neutral. Even if we come back to 2%, it's not really justifiable to cut. Where do you stand on the restrictive to neutral argument?
Yeah, I think she's certainly on the more hawkish end of things. I would think that this level of rates is restrictive. And we see that in very low hiring, gradual loosening in the labor market at least. The rate-sensitive sectors, housing, manufacturing, those still seem relatively soft. We've seen some stronger manufacturing data recently, but maybe that doesn't last. So I do think that this is still a restrictive level of rates.
The compilation of headwinds to this economy are coming. You've got tariffs, you've got restructuring via DOGE, you've got a number of fronts there. Where do you sit? We've had Adam Posen and State Street this week talk about stagflation. How real a risk is that for you?
Yeah, if we are getting into, policies like substantial immigration changes, maybe tariffs would be part of that. There is a risk that policies would mean softer growth and higher inflation. But maybe because that's what they would entail, we don't think that we'll be getting those big disruptive kind of policies. We're not expecting mass deportations, for example. We're not expecting the big disruptive 25% tariffs on Canada and Mexico. So I don't think that is a high risk right now, at least.
Look, the other big unknown is the revision to last year's numbers. I think in August time we thought it was going to drop by 818,000. That's been drifting downward. Are you in the downward drift camp to the revision?
Yeah, we never really know, and you know, how do we know?
And there's no press conference today to discuss it.
There isn't. We never really get a whole lot necessarily from the BLS, and how do we know a whisper of revisions? I think it's probably likely that we'll still see some pretty big downward revisions, maybe something like 700K.
And if it's more than that, then that's a material number to you.
Yeah, I mean, 700K is already a pretty material number. Those would be some of the largest downward revisions since 2009. I think it is just reflecting that there are a lot of measurement issues with a lot of this data post-pandemic, which is why, you know, to form your view on what's happening, you have to look at many different data sets over many different months, and that's where there does seem to be a lot of weakness in this labor market.
Well, Veronica, you're in alignment. 197 on the Whisper, and you're at 195. So thank you very much for joining us, setting the tone there. Veronica Clark of Citi. On Jobs Day, and there are stories trending on your Bloomberg Terminal this Friday morning. Amazon in the news, they're warning investors that the cloud computing division could face capacity constraints despite the plans to invest $100 billion this year. CEO Andy Jassy says growth will be lumpy due to delays in getting hardware and insufficient electricity. This echoes similar concern from Microsoft, which had concerns about keeping up with AI demand. And China's growing influence in AI has sparked optimism towards the nation's tech shares, with Hang Seng Tech Index entering a bull market. And DeepSeek's model has been hailed as a game changer, prompting the broader reevaluation of big tech companies. Wall Street brokers are upbeat, arguing that the Chinese discount will vanish. And shares of Nissan climbing as Foxconn reportedly is making another pass at the car maker as its tie-up with Honda falls apart. It backed off in December after a deal was penned to bring both brands under a single holding company. Honda and Nissan confirmed this week that they're still discussing various options, including the possibility of ending negotiations.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bloomberg Brief. I'm Manasquani in New York. In just 2 weeks, the Treasury Secretary, Chief Scott Bessent, has seen plenty of turbulence. The department became the target of Elon Musk's crackdown on federal spending, triggering protests outside Bessent's office. Investors have been on edge since President Trump has dangled the implementing of tariffs. Yet, in an interview with Bloomberg TV yesterday, Bessent sought to telegraph a sense of normalcy. Let's just unpack that a little bit. What did we learn from the interview? Kevin Whitelaw is with us. Kevin, good morning. Good to see you. So here we are. I would say this, if you listen to that interview, the messages were very clear from him. It was about control and systems control, and it was about trying to quell the anxiousness of the bond market and really reassure the dollar hegemony.
Well, Scott Bessent was chosen in part after what had been a longer deliberation than for many of Trump's other cabinet picks, was chosen to be a reassuring signal to markets. And, as someone, a market professional who's going to come in and sort of keep things on track for what Wall Street was looking for. And so a lot of this interview was about a sort of projecting a business as usual kind of moment, talking about, not meddling in, sort of the Fed's business and maintaining a strong dollar policy and other reassuring messages. But obviously at the same moment, you do have Elon Musk and his team of Doge, engineers running around and accessing the system that pays America's bills with very little transparency or really any clear sort of official mandate or record keeping. And so I do think that as much as there was that surface message, it really sort of is a little hard to take at face value when obviously there's this enormous level of disruption going on underneath the surface.
And then, of course, he talked about the alignment between himself and Elon Musk and on those people in Doge, highly trained professionals. That is not some roving band running around doing things. As you say, it's about reassurance. Let's flip over. There was an offer to take early retirement to a lot of federal employees. We understand that number is at 50,000. That's not what they'd hoped for, and now they're pivoting to perhaps a slightly more aggressive policy here, aren't they, in terms of looking at people's review sheets, their yearly review sheets?
Yeah, I mean, I think this the numbers on the buyout, which I believe a court has also hit pause on for a little bit, does show that there's maybe a lack of trust on the part of federal workers about what this offer is and how real and how firm and clear the terms are. A lot of federal unions warned their workers against taking it up, and so that was the carrot, and Trump also has the stick, and there is talk about layoffs. There's talk about tougher performance reviews, and you're also watching what's happening at USAID, where a whole agency is facing the threat of layoffs, and that's only sort of the first. We're only 2 weeks into the administration, and so he's not done. He's going to pursue a lot of different avenues, but you're also, I would expect, going to see a lot of court challenges from individual workers, from unions, and others who are going to say that Trump doesn't have the authority to do this.
Look, we're trying to understand whether we're going to have one big, beautiful bill or not, but the tax bill is rising. There's lots of promises. President Trump met with the Republican lawmakers to talk about these tax priorities. He wants that SALT cap raised, but to do that, he's got to look at some pretty old principles. Private equity world are a bit worried now. Carried interest is back on the chopping block, as it always is. What else is on the agenda to pay for the tax cuts?
Well, I do think, he is targeting some of these favorite, slightly more populist sort of themes, even as he's basically also still trying to do a tax cut that's going to benefit the rich. So it is a weird mix of populism and not populism, I guess, if you'd call it. But Trump does face that deeper problem of he really wants to cut spending as much as he can, but he really wants to cut taxes even more. And so how do you do that without ballooning the deficit? And I do think this SALT tax is an obvious target. He talked about it a lot in the first administration. It's coming back, and it is something that if he targets it right, it conveniently tends to hit Democratic-run states a lot more painfully than it does Republican ones. So it does kind of fit in with that broader message of us versus them.
Well, look, the Senate and the House have already split this week in terms of their intentions or their indicated intentions in terms of bills. The Senate obviously wants to go for something a little bit skinnier and have a victory sooner. This split, how does it get healed between the Senate and the House?
It's going to take a long time to sort out exactly where they can head with this, but at some point it's going to come down to votes, and the House has the thinner margin. The House has a very, very, very thin margin of control for the Republicans. They cannot afford to lose many votes, which means that there is a bit of a lowest common denominator problem that they don't have in the Senate. Senate, on the other hand, does have still a couple of traditionalists who have very strong feelings about certain, spending programs and certain levels. And, we haven't seen a lot of fight from the Republican Senate yet in terms of Trump's agenda. But at some point, when it comes down to money, when it comes down to things that are going to hit districts hard, hit states hard, politics is going to come back into this very significantly.
Kevin, thank you very much. Kevin Whitelaw there with the very latest on the political machinations in Washington. The bond market is ground zero. We're here for Jobs Day. The consensus whisper number is 197,000. But what I want to show you is really the past 5 days in the bond market, which has been pretty prescient. Down 10 basis points. We've been falling for 4 weeks in a row now in this bond market, and you have not seen that since 2021. A very clear message yesterday from the Treasury Secretary. We want control. We're aiming to control the curve. There's your performance in 10-year government bonds this week. And again, this adds to the narrative for HSBC, Max Kettner, which is about emboldening his view on taking risk. BMO says we're listlessly shuffling towards this jobs report, as Laurie Logan says she's skeptical, really, about already at the neutral rate. And even if we get to 2%, doesn't necessarily mean a cut. As you can see there, the slope down in those bonds on yield for 4 weeks in a row.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
brief. I'm Menace Crenny in New York. A look at the rest of your day. Guess what? It is the January payrolls, 8:30 a.m. Eastern. We will bring you that live and analysis in Bloomberg Surveillance, followed by the University of Michigan consumer sentiment data at 10 a.m. and those inflation numbers in there as well. Fed speak, plenty of it. Governor Bowman at 9:25 and Governor Kugler at 12 noon. There's some stocks to keep an eye on as well. We have Tesla. China's January total shipments dropped by 11.5%, and that's based on the preliminary data released by China's Passenger Car Association. Amazon continues to dip as the currency headwinds weigh on the outlook. It also gave a warning that it can't keep up with the AI demand. And Expedia extends post-earnings gains on robust results, reinstated its quarterly dividend. When it comes down to controlling the market, Scott Bessent has had a bumpy first 2 weeks. The Treasury chief has had to deal with the controversial crackdown on the federal spending, the threat and reality of President Trump's tariffs. Yet in an interview with Bloomberg TV yesterday, Bessent sought to calm the markets and assure stability.
These are Treasury employees. It is 2 Treasury employees, one of whom I personally interviewed in his final round. There is no tinkering with the system. They are on read-only. They are looking. They can make no changes. It is an operational program to suggest improvement. So we make 1.3 billion payments a year. And this is 2 employees who are working with a group of long-standing employees.
The letter that the Treasury Department sent earlier this week talked about how the team currently does not have access to change the system. Have they at any point this year had the ability to make changes?
Absolutely not. This is no different than you would have at a private company. And by the way, the ability to change the system sits over at the Federal Reserve. So it doesn't even lie in this building. So they could make suggestions on how to change the system, but we don't even run the system.
And if they ask for, if they request the ability to change the system, would you grant that?
No, again, they have no ability to change the system. I have no ability to grant that change. That they could make suggestions, then it would go to the Federal Reserve, and just like any large ERP system, there would be tests, there would be this, there would be that, and then the Fed will determine whether these changes are robust or not.
As the Secretary of Treasury, you also oversee the IRS. Do you know what kind of access the team has to IRS data or individual taxpayer data?
Well, I'm glad you asked that too, because look, the IRS, the privacy issue is one of the biggest issues. And over the past 4 years, we've seen a lot of leaks out of there. The IRS systems are quite poor. When I started in college in 1980, I learned the program in COBOL. I think there are 12 different systems at the IRS that still run on COBOL. But as of now, there is no engagement at the IRS.
And if they request that access, would you sign off on that request?
They haven't, so we'll take that when it comes to it. I think there is a lot to do there, but the president was elected with a big agenda, and to the extent that getting the IRS in better shape is part of that, sure. Because look, with the IRS, what am I concerned about? I am concerned about collections, I'm concerned about privacy, and I'm concerned that the system is robust.
That was the Treasury Secretary, Scott Bessent there, speaking to Bloomberg. The Whisper number is rising. It is Jobs Day in the United States of America, 199,000 on the Bloomberg Whisper number. The dollar is flat, likewise with equities. Get ready for a potential 1% swing around in these equities. That's the view in the options market. I'll leave you with that view. Bloomberg Surveillance is up ahead.
prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Have a robust labor market. That's a key fundamental pillar to the U.S. strength and the U.S. outperformance.
We've been seeing that the labor market have been holding up pretty well.
Very hard to argue that the labor market is retightening.
The U.S. is doing considerably better than the rest of the world.
We are seeing some signs of loosening in the labor market and deceleration in growth.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
It's Lisa's favorite line. Let's get you to the weekend.
100%.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now on a 3-day winning streak on the S&P 500. Your scores look like this. Equity futures totally unchanged on the S&P. On the Nasdaq 100, we're negative not even 0.1%. The main event, 8:30 Eastern Time, the jobs report. The estimate in our survey, 175. The high, 240. Lisa, the low, 105.
The question I have is, what's the potential risk for markets? A downside surprise or an upside surprise? I'm going to just venture to bet that if it was 260,000 on a headline print, it wouldn't cause some sort of wild freak out about a reacceleration of the labor market. What you might get is discussion about how random this number is, the upside surprise that always happens in January because of seasonals. But this is a market that has moved beyond the overheating narrative to concern about potential cracks in the labor market.
Dead on. We've taken some heat out of the story so far this week. We saw that in jobless claims, just a little bit softer, but no drama. Saw that in job openings, saw that in the ISM as well, with prices paid falling back. Laurie Logan of the Dallas Fed, in no rush to do anything. What if inflation comes in close to 2% in the coming months? Well, that would be good news. It wouldn't necessarily allow the FOMC to cut rates soon, in my view.
She's talking about neutral rate being around where we are currently. She is on the hawkish side of things very clearly. At the same time, what's interesting to me is how little this moved the market. People basically looked at this and said, yeah, okay, one hawkish member sort of trying to put out this possibility. They'll move according to the data, and they're not giving any forward guidance. Right now, people are looking for cracks. They're looking for downside surprise, and it is no longer the Fed. It is that 10-year yield that Scott Bessent has squarely highlighted.
40 basis point move off the highs of last month. We're also waiting for the policy changes. So here we are. Bear with me. The president's tax plan. End taxes on tips and overtime. New cuts for Made in America products, extend TCJA back from 2017. All familiar with those plans. Expand state and local tax deduction, got it. Then they threw in this yesterday. End the carried interest loophole. Did not see that coming.
Did not see that coming, as well as ending breaks for sports team owners. These are two new provisions that the president is throwing out there that he never mentioned on the campaign trail. All I would say for this, for both of you, if this Republican majority passes closing the carried interest loophole, I will buy dinner for everyone. I do not see this happening, but he's coming out with an even more ambitious tax plan.
What's shocking to me is he is surrounded by people from Wall Street, from the private equity industry, from the private debt industry, and this would target them. This basically says you can no longer pay the lower tax and treat some of your carried interest as simply long-term gains. So all those private equity managers, this is something that one estimate has potentially raising some $12 billion over 10 years for the IRS. Sounds great. I just don't see the support for it in the people he's surrounded by.
That's a man who's not running again. There are plenty of people in Congress who are running again, and to your point, I wonder how that complicates things, but I wouldn't be surprised by anything at this point. Would you be? We had an opportunity to do that under the Democrats. Didn't happen. Why? Kyrsten Sinema. So I wouldn't be surprised by anything. Let's see what happens.
And what's so interesting is actually the Democrats ran on that. They said we want to be able to make sure we are taxing billionaires and those Wall Street elite that have special tax breaks, and yet, when push came to shove in the 11th hour, because of Kyrsten Sinema, they weren't able to do it. And they had control of the House, the Senate, and the executive branch. Now Trump also has that same level of control. People I'm talking to say, don't even ask me about this. It is not happening. But you're right. Maybe anything is possible, especially he's not running. But you know who might be? J.D. Vance.
Stay tuned. You're just worried about the dinner bill now. Equity futures on the S&P, just about unchanged. Coming up this hour, we'll catch up with Chris Verona, strategist ahead of the payrolls report, Kim Wallace of 22V Research on Trump's tax priorities, and Shweta Kajuria of Wolf Research on Amazon's week outlook. We begin this hour with stock steady as traders await U.S. payrolls at 8:30 Eastern Time. Chris Verona, strategist at Baird Company, looking to the bond market and writing, we take some comfort in 10-year yields decisively breaking below 450. This is the debate of the day. Do lower yields support cyclicality or suggest growth is slowing? Chris joins us now for more. Chris, good morning. Good to see you.
Great to be here, John.
Does the equity market help answer that question?
Yeah, I think so. We can look to kind of the impulse of leadership to get an idea of how the market feels about this growth versus inflation debate. And I think that's the big question as we kind of settle in 4 or 5 days past the initial tariff announcement. The debate that we're having in every client meeting, is it a hit to growth? Or is it something that restokes inflation down the line? If it's the latter, I would not expect to see oil on the lows. I would not expect to see energy stocks continuing to surrender relative leadership. So I don't lean to the inflation camp here. I lean more towards the growth camp. I think we're okay at the moment. Financials still lead, credit's still okay, but I do want to be vigilant here on the growth side, particularly with bonds. If we're sitting here in a few weeks and say 2-year yields are back under 4.05 or 4%, you begin to wonder, what is the market trying to message to us about where growth goes from here?
Do you think the conversation changes as we start to talk about taxes a whole lot more? The sequencing was interesting here. Yeah. Started with trade, started to shift back to taxes. Does the conversation of the bond market shift too?
Well, if you remember during Trump 1.0, the debate around what would ultimately become the tax cuts, that was when cyclicality and growth were at their most pronounced. It's actually when the tax cuts passed in late 17, early 18 is when cyclicality began to roll over, and you begin to get this very odd divergence between bond yields were still going up, but cyclicals were underperforming. That is never the combination that you like to see. I don't think we have that here yet, but I do want to just be on guard for it.
Given the fact that there has been this rally in the long end, does that give you real confidence that this shift into that equal weight trade, that shift away from big tech, is sustainable, has legs?
Well, let's make a couple points here. I'd say number one, we were sitting here a month ago with on Payroll Friday with yields roughly at 475 or 480, and we had a relatively hot number. And here we are a month later, and yields are under 450. So it seemed like we did a lot. A lot was priced in at 475 or 480. I would be surprised if we got them back above there. I've generally been more sanguine on bonds. I think ultimately 10s probably settle in the 415, 420 neighborhood. Now, what does that mean in terms of the market's tone or messaging on growth? I think there's two things we need to watch here: financials and credit. It's so consistent for the last 18 months. Financials have been your leadership. Credit conditions have been remarkably benign. So if something is changing, I think that's ground zero. That's where we got to spend our attention.
Right now, it seems like people are positioning more, girding for a potential growth shock, as we've been saying. How asymmetric, and this is a point that Priya Misra made, and she's going to be on the show later this morning, how asymmetric is this market positioned, asymmetrically, in terms of a downside surprise being a much more significant driver of market activity than an upside surprise?
Well, it's funny. Again, it was only 3-4 weeks ago where people were extremely worried about bond yields going to 5, 5.15, 5.25. Just think of how quickly the plot changes in this game that we all play every day. Listen, the last 2 years, 10-year yields have averaged about 4.15. we're near that average right here. I think on balance, that's probably better for equities than it's not. I think you start to get the long end under, say, 4%, 390, 380, then you begin to really wonder why. What's the messaging there on growth? But I would say, just with respect to big tech or some of these big stocks, I don't think it's yields that are the big story. I think dollar yen is the big story here. And you think about the last 10, 12 years, all this money that's moved into the top of the market, big cap tech, the mega cap stocks, it's been coincident with this yen carry. What changed in July, right? When did dollar yen peak? It peaked July 10th. When did tech relative versus the S&P peak? Also July 10th. These two are tied at the hip here. And where's yen this morning? 151, 152. So something has changed here. All the other yen pairs, as I'm sure that you've noted, have all rolled over. This, I think, is the bigger story. Does the east to west flow become less pronounced when dollar yen is off the playing
Let
field?
me jump in. 4 weeks of yen strength.
Yeah.
Noted the same thing. Also in Europe, there's corresponding pickup in European equities. The DAX is up by 10% year to date. Year to date.
Yeah.
It's not even mid-February. Is the European equity story part of that call as well?
I remember a few weeks ago, I was sitting, I think I was watching maybe your program, and Christine Lagarde was in Davos, and I think she used the phrase that she was peak pessimistic on Europe. And I'm like, wait a second. We have a pessimistic central banker. At the same time, the Euro banks are making new highs, the Euro industrials are making new highs, European credit's benign. I want to be a buyer of pessimistic central bankers when the market tells me that I should. So I like Europe here. We have liked Europe here. In the very near term, it's probably tactically overbought. It's been a remarkable start to the year here. But as long as these banks are involved, I think you stay long Europe. And also just know, all these luxury names, which everyone says are so tied to China, they've all bottomed. They've all turned. So should we entertain the idea that maybe the Chinese economy has found some trough here? I think so.
Do you entertain this idea if Donald Trump puts tariffs on European Union products?
I entertain the idea, or I embrace the idea that I know I don't know, right? Number one, first rule of our work, we know that we don't know. I value the market's opinion over my own, and certainly the market knows the possibility of all these things, yet Europe carries the flag of leadership to start the year, so I think there's some messaging in that. And remember, we've had a reset in Euro USD, we've had a reset in sterling, we've had, frankly, look at these European short rates. We've had a reset in European short rates. That sounds more constructive for the equities than not.
So do you think the market is taking all of Trump's threats when it comes to the European Union as that's just it? Threats and warnings, he wants a deal. He's not actually going to put the walls up.
I'll let the experts kind of make that decision of ultimately where this goes. I think what's most important is, we have this delicate balance right now. On one hand, we have this tariff threat looming. I think on the other hand, you have weaker currencies and lower bond yields throughout the continent, which generally stoke stocks. So I kind of think the market's more focused on the latter at this point. And I think the message from the leadership in Europe is really constructive here. Discretionary better than staples. Banks very strong. Seems like the market's okay with that.
Final question. We catch up with the NEC director, Kevin Hassett, a little bit later on this morning, following the jobs report. What do you want to know from the administration? What's your number one question right now?
Yeah, I think the big question here as we kind of look out over the next 4, 5, 6 months is what is maybe the pain threshold for maybe some of the policies relative to the economy. I think the bond market is going to be my judge on that. We go back to Trump 1.0. I think what was misunderstood was there was always this view that there was a Trump put on the market. Well, there were some pretty deep corrections
2018
in Trump 2018. Certainly even 2019, the market was kind of beginning to come under some pressure. So I'm a little bit skeptical of this idea that there's some immediate Trump put, S&P's down 3 or 4%. We'll see. I'm skeptical of that.
Hey, Chris, it's good to see you.
Great to see you.
Chris Verone of Strategas, a bad company, with some real advice for Europe. Fade Lagarde, not my advice, his advice. I'm paraphrasing. Equity futures on the S&P. You're for real, right? Fade Lagarde. You want to reiterate that?
It's buy Lagarde, right?
Buy Lagarde.
Pessimistic central bankers. You buy pessimistic central bankers.
But you fade her view?
Yes.
Yes, okay.
I actually wrote that down. I want to be a buyer of pessimistic central bankers. I want to have a T-shirt made of that, and I would like to wear that on Monday. So, yeah, I'll credit you at the bottom.
Thank you.
Perfect. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Shares of Amazon are falling nearly 3% in the pre-market. The company reported better than expected revenue and profits for the holiday season, but its guidance for the current quarter fell short. Plus, despite plans to invest $100 billion this year in AI infrastructure, Amazon is warning it could still face capacity issues in its cloud computing division. President Donald Trump held a meeting with U.S. Steel CEO David Burritt at the White House amid growing questions over the company's future. That's because former President Joe Biden blocked Japan's Nippon Steel takeover bid, and Trump has also said he's opposed to a sale. Trump is due to welcome the Japanese Prime Minister today. And Trump has tasked his Vice President, J.D. Vance, with overseeing the future of TikTok in the U.S. Punchbowl is reporting that Vance will work with National Security Advisor Michael Waltz. On his first day in office, Trump issued an executive order giving TikTok a 75-day extension to find a buyer in the U.S. or face a ban. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. Up next on the program, President Trump's tax agenda.
This will be the largest tax cut in history for middle-class working Americans. The president is committed to working with Congress to get this done.
That conversation up next with Kim Wallace of 22V Research, live from New York City on this Payrolls Friday. Good morning.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Live from New York City on this Payrolls Friday, the estimate in our survey, the median, 175. The number drops in about 2 hours and 15 minutes time. Equity futures going absolutely nowhere going into that, pretty much unchanged on the S&P. Likewise in the bond market, the 10-year 4.4283. This can all change at 8:30 Eastern time. Under surveillance this morning, President Trump's tax agenda.
These are the tax priorities of the Trump administration. No tax on tips, no tax on seniors' Social Security, no tax on overtime pay, renewing President Trump's 2017 middle-class tax cuts, adjusting the SALT cap, eliminate all the special tax breaks for billionaire sports team owners, close the carried interest tax deduction loophole, tax cuts for Made in America products. This will be the largest tax cut in history for middle-class working Americans. The president is committed to working with Congress to get this done.
So here's the latest this morning. President Trump outlining his tax priorities with GOP lawmakers as the party struggles to align on a strategy for passing the legislation. Kim Wallace of 22V Research writing, a clear framework and strategy for enacting fiscal policy this year remains elusive for the majority. We stick for now with our call that a tax package is unlikely before December. Kim joins us now for more. Kim, welcome to the program. I want to pick up on that last line. By December, it's unlikely. From your standpoint, why is it unlikely? What's holding it up?
I think there are two related reasons, John. Good morning. The first is that margins are very narrow in Congress. Until April, it will be a one-vote margin in the House. And after that, as much as maybe a three-vote margin. We saw in December that empowered a lot of members to act as free agents to make demands and to reject demands before they were able to fund government and go home for the holidays. The second is the size of debt and the size of the bill to renew tax package, and as the spokeswoman said, add additional tax cuts to it. So you start with 4.5 trillion of an offset whole, and it grows to 5 or 6 depending on what you add to it. It's going to be an arduous process. Negotiating the substance is going to be even more difficult. It'll take time.
Kim, is that why the Senate is talking about this two-path approach, because they want that quick win? Do you think that in the end, they're going to be the ones that win?
That will depend entirely on the president's preference, I think. And yesterday was really the first time you saw the president engage in fiscal policy for this calendar year. Similar to 2017, House and Senate, mainly the House, wrote the original tax cut bill. 2017 wrote the original bill before the Senate picked it up. That's usually the course because tax policy starts in the House, and therefore that usually sets the process. Importantly, Senate rules are much more difficult, so usually you go last in the Senate to see what you can squeeze through.
Kim, a surprise was added yesterday, ending the carried interest tax break used by private equity firms. Is that real?
In two ways, no. One, 20 years ago when it was originally proposed, it had teeth, it bit, it raised a good bit of money. Over the years, that's been eroded by, obviously, the interests who don't agree with changing the law. And relatedly, it doesn't raise much money now in its current form. And I doubt that there are a lot of forces focused on this as a primary offset. The messaging probably not right from a Trump-based standpoint, and you just don't raise a lot of money.
Hold on a second, Kim. You said that it's not quite right from a Trump-based standpoint. Which base are we talking about? Because more broadly, to tax billionaires, et cetera, is a very populist message and probably would appeal to a large swath of Donald Trump's supporters.
It's been a populist message when populism was spelled with small letters. And it remains one. It's never driven negotiations on tax policy. Taxing the rich is a great slogan. It doesn't show up in the negotiations of tax policy.
Then what do you take?
The contrary. 2013, 2015, 2017, the higher end tax earners saw their taxes reduced each of those times, disproportionately.
So, Kim, what do you make then of this being thrown in? I mean, if you can understand the strategy behind negotiations, which a lot of people say are going to be very difficult given that there has been some sort of unity among Republicans so far, but that's only to placate the different parties ahead of a very vicious fight over the budget. What's your inference about where the lines of fighting will be when it comes to the budget?
Oh, I think there are many. That's why we're in February, and there's still no framework for even a budget resolution, just to put out broad numbers and assign savings to the various authorizing committees. That's usually not a big step for the majority, but because of tight margins and because of debt aversion, and it's growing in Washington among elected members, both parties. This process has been very difficult, chaotic, and has not yet produced unity. Not only has it not produced unity within the Republican Party of the House, there are very scant conversations between House and Senate Republicans how to move forward. That's why Senator Graham asked for a meeting with the president, hoping it would catalyze the process. The difficulty is the constraints on elected members, and there are many. And while taxing the rich is popular, when you look at the items the president's spokeswoman mentioned yesterday, most of those erode long-term health care and retirement funds for working people. And in a package that would cut taxes for people in the top half of the income brackets, it's a curious mix. I don't think the messaging holds.
But Kim, you and I both know they need offsets, which I also want to get your take on how much of that offset is going to be driven by the tariffs President Trump has been talking about.
The U.S. brings in around $90 billion a year in tariff revenue. It's in the offsetting receipts category. I've spoken to people who have modeled as much as doubling that. The whisper is that Speaker Johnson's back of the envelope, if you will, has as much as $2.8 trillion over 10 years in tariffs. Not many people think you can raise that amount of money, but the statement is that they will rely on tariffs and tariff revenue to help offset some of the spending. I think the takeaway there is not so much how much can they ultimately raise or even plan to raise, but the fact that they've admitted tariff revenue is necessary as an offset.
Well, there's going to be a lot of spending.
Likely going to have some tariffs later.
That's for sure.
Year.
Hey, Kim, appreciate your time. Thank you, sir. Kim Wallace there of 22V Research. Let's talk about that spending. The tax priorities of the Trump administration maybe colliding with the thoughts of the bond bulls out there who got excited about the words of Treasury Secretary Scott Bessent earlier this week. No taxes on tips, no tax on senior Social Security, no tax on overtime pay, renew the president's 2017 middle-class tax cuts, that's TCJA. We're all expecting that one. And then there's going to be tax cuts for made-in-America products as well, adjust the SALT cap too. That's a long list.
Long list, it's a lot of money, which to Chris Verone's point is, his number one question to Kevin Hassett is, what are they looking at to potentially push back on their spending plans? Is it going to the bond market that ends up having a seat at the table and says, this is just too much for the deficit?
This is reason why it's so hard for analysts to come up with any conclusions. Because on one hand, you have the sweet words of Scott Bessent basically saying that if you look at the bond market, that'll be the ultimate check on what we're trying to do. And if Trump's policies go into effect as planned, you're going to get disinflationary growth, which is the sweet manna of markets. And then on the other side, you have a lot of people saying, look, we have these priorities and we can tolerate everything that it comes with it. And a little bit of pain is worth it in the long run. Which is it? And can that pain be tolerated in the bond market?
This is going to be a lot of issuance at the front end if the comments of the Treasury Secretary are anything to go by, who didn't seem too interested in adjusting the maturity profile of the Treasury debt anytime soon.
He was so nuanced in the way he answered that. He said, not anytime soon. Later this year, when some of President Trump's policies have gone into effect, if we get disinflationary growth that leads to some sort of lower yield regime, this is the implication, we can rethink about what that looks like. Essentially, this is him saying with Janet Yellen's much criticized plan, but also sort of implying that there's some line where if yields drop low enough, maybe they could term out the debt. I'm curious, what is that line?
I'm just going to guess if he said something different, if he said the opposite earlier this week in the 2 interviews he'd done, the 10-year wouldn't be at 442, it would be somewhere else, and that somewhere else would probably be higher.
Which is the reason why he didn't say it. And again, it shows how he is so laser focused on not screwing around with the market right now, because he wants that to become constant to create the pathway for some of the stability that Donald Trump is talking about.
We're laser focused on the jobs report. That drops in about 2 hours and 5 minutes time. A sneak peek of our survey here at Bloomberg. Lots of estimates go into this. The median at the moment is 175. The previous number is 256. Lisa and many of you very focused on the benchmark revisions. We'll catch up with Sarah House of Wells Fargo and Anna Wong of Bloomberg Intelligence, of Bloomberg Economics a little bit later this morning, so look out for those conversations. Up next on the program, we'll catch up with Shweta Kajuria of Wolf Research as Amazon looks to keep up with AI demand. From New York, you're watching Bloomberg TV.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones. Can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never. Go.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
2 hours away from the jobs report. 175 is the number we're looking for. The previous number, a very punchy 256. We'll see what we get at 8:30 Eastern time. Going into it, the scores look like this. 3-day winning streak into Friday. On the S&P, we're just about unchanged. On the Nasdaq 100, we're negative by 0.1%. Lots of conversation about the bond market. 2-year, 10-year, 30-year. Let's sit on 10s. 10s right now, just about unchanged. 443. Priya Misra, JP Morgan Asset Management, on the program a little bit later. What will generate the bigger move, Bramo? You referenced it. A weak report or a strong report?
She thinks that a weak report is the thing that's going to really cause the bigger ripple effects in markets. And it makes sense given how much we've reset away from an expectation of overheating toward searching for cracks. That has been the focus of so many people. And if we don't see cracks, well, all systems go. I will also add, nobody is taking this number that seriously on the upside because they're all talking about the fictitious upward revision that happens seasonality.
The 10-year yield is on track for its fourth weekly decline. Fourth consecutive weekly decline. And I had to check this multiple times, Lisa. The longest streak going back to 2021. I was quite surprised by that. It's been that long.
We've gotten upside surprises to inflation pretty steadily until maybe about 6 months ago. And then you started getting those downside disinflationary surprises, yet the market was still worried about overheating. Now maybe is the sort of catch up that we maybe should have had a couple months ago.
Guess what else is on a 4-week streak? With that in mind, the Japanese yen. Dollar yen declining for 4 consecutive weeks. That's yen strength. Dollar yen right now, 152. Just about weaker against the dollar by 0.5%, but more yen strength through the last week or so. Chris Verone on the program a little bit earlier, a strategist, making the point that this is, I think, capturing the flow story. This speaks to the outperformance that you're starting to see in the equity market, just the money going elsewhere.
A lot of people said that the reason why the U.S. markets had been so strong for so long was because there was such weakness over in Japan and some of these other economies that they had nowhere else to go but the U.S. If that shifts, does that flow of money shift as well? And what Chris Verone was saying is it's directly correlated with some of the weakness you're seeing in U.S. markets.
And some of the strength we're seeing on the DAX, for instance, in Germany, 10% gains so far this year. Unreal. Dollar yen right now, 152. Let's get you some top stories. On our radar this morning, Treasury Secretary Scott Bessent expressing confidence in Doge, telling Bloomberg he personally vetted the Treasury employees on Elon Musk's team, and there's been no tinkering with the department's payment systems.
And he called it one of the greatest audits he thinks in his adult life. The issue is actually on the other side of Pennsylvania Avenue. Half a dozen Republican senators are reaching out privately to the White House and saying they object to this. There's a lot of cause for concern that these individuals have access to the Treasury system. And then, of course, yesterday we saw a federal judge actually temporarily limit that access and only giving those workers read-only because a group of unions accused them of illegally sharing members' information. The story's not going away, and I'm sure it's providing a ton of headaches for the White House.
Scott Bessent did a very good job of just sort of smoothing over and saying, look, it's not even us. It's the Fed. Look at them. And by the way, I talked to the Fed, and I can criticize things in the past, but looking forward, you know, I'm not going to give them guidance. Things are all normal, and they're going to operate as status quo. That was a message that was very much at odds with some of the make it, break it, and as quickly as you move.
Democrats and Republicans, both these administrations, under the Treasury Departments of either party, will always say that it doesn't have the power to stop or prioritize these payments that are authorized by agencies. But obviously, people are looking into them, and that has been a massive cause for concern.
The complete policy platform has got lost. It's been buried by the trade headlines of the last week. It's been buried by all the attention that goes to Doge. We have to keep going back to the tax platform. The tax cuts could be massive this year. They did a decent job of going through some of the priorities, but one of the standouts and the surprise, I think, for us all, was calling for an end to the carried interest tax break. Did not see that coming from the President of the United States.
Did not see that coming, because remember on the campaign trail, we called this the Oprah Winfrey election. Every day there was a new tax policy, no tax on tips, no tax on overtime pay. Donald Trump was throwing almost spaghetti at the wall when it came to taxes. He already had TCJA, and he wanted to expand it even further. So when it comes to putting out the carried interest loophole, many people are interested in this because a lot of private equity firms and leaders that backed him and are probably going to be calling the White House saying, hey, what's this about? But you brought up a great point earlier, which is the fact that for populists and those individuals in the MAGA base, this is really going to resonate, which is potentially why someone like J.D. Vance might be behind this.
So according to McKinsey, about $8.2 trillion was under management from private equity funds. If some of the carried interest, which is basically how much, the 2 and 20, it's the 20 that they earn, the 20% on some of the investments that they make, if that gets taxed at the same rate that everything else does, the estimate is that could raise $12 billion. It's a drop in the bucket, but you need a lot of drops in the bucket when it comes to the overall, U.S. budget to fill these plans. If it is realistic, it shows that maybe this is going to be a very different type of budget plan than many people were expecting.
Is it about the politics or the money? And I would suggest it's about the politics, and I think you made a really good comment about 15 minutes ago. Whose base? The president's base has got a lot of people in it from a lot of different places. This is a populist message coming from a populist president.
It's a president who has many different bases, as you say, and the base that he has surrounding him seems to be the base that's probably earning some of that money from those $8.2 trillion of private equity assets. Question is, how much does he have an eye on what the message is going to look like and what those headlines are?
This is one of those policies that you see and you're like, this is going to create weird bedfellows in Washington, D.C., because this is something Senator Elizabeth Warren or Bernie Sanders would absolutely vote yay on.
If you polled Wall Street, maybe you'd get one answer. If you polled the country, I think you'd get the obvious answer. They want this gone. It makes sense. You poll the country, this is where they are right now.
Everybody has agreed. And one of the big questions is, why has it been so hard to get through?
Special interest.
Can he push through that, especially at a time where they need to raise money?
I still maintain it's not happening, and if it does, I will buy you all dinner.
And if it doesn't, it's because of special interests, as always. Let's turn to this story. President Donald Trump meeting with Japanese Prime Minister Ishiba at the White House today. Officials familiar with the matter telling Bloomberg Trump met with the U.S. Steel CEO just yesterday. Could we see a change here too?
Potentially. Do you know why? Donald Trump has been, as we've been talking about, everywhere, doing everything all at once. What has he not been commenting on? This takeover, this U.S. Steel takeover. Potentially there is a way he can sell this to the American people. I might allow this deal. I spoke to the CEO. The company needs this money, but I still will protect U.S. aluminum. And at the same time, in steel, maybe he'll put up tariffs alongside of it.
I love imagining these meetings between the prime minister that come there. Here, I have this. Take this thing of roses, take this thing of chocolates. Okay, here's the deal that we're going to make, and they discuss it. Is this sort of the goal, too, to be able to have deliverables? We get this, they get this, we made a deal, it's all beautiful, we can move on.
He's very transactional. So yes, if there's a potential deal to be made, I could see it happening.
Let's turn to tech. The latest earnings from Amazon delivering better than expected earnings, but giving disappointing guidance for the current quarter. The CEO, Andy Jassy, warning growth will be lumpy due to hardware delays and power constraints. Shweta Gajuria of Wolf Research rating the stock outperform with a 270 price target. Shweta joins us now for more. Welcome to the program. First question, what we just heard from Amazon, how much of that was in line with what we'd heard from other players, the likes of Microsoft, for instance?
Well, thanks for having me. I would say the parts that were similar from at Amazon from Andy Jassy to Microsoft and Google and Meta was around CapEx and cloud. So what we heard from Andy Jassy were two things. One is that these CapEx investments, where they guided to over $100 billion in CapEx for 2025, they are leaning into what they believe there is demand for, and they would not be spending this money if they did not know that there was demand coming, because you procure all these infrastructure and data centers only if there's demand. And we have heard that time and time again from Google Cloud, from Sundar, as well as at Microsoft. That was part one. Two was his comment around and his reaction to what happened with DeepSeek and their R1 model. And the commonality here is basically the same thing that we heard from Zuckerberg at Meta, as well as Sundar at Google, around if costs of training and inference go down, the intuition is that the demand for AI will likely expand. It will expand the TAM because there will be so many more uses that will be attractive around applications to drive AI compute. And against that, all these companies are leaning into CapEx spend.
Shweta, so many analysts after these earnings came out pointed out time and again, this is still a behemoth. They're going to do very well. We don't understand why people are punishing them. And yet 4 out of 6 of the magnificent 7 that have reported so far have been meted with a really disappointing response in markets. How much do you think that ultimately this is investors saying we are worried about valuations and we're not going to extend things further, period, even though there is still that same promise of cloud computing?
I think it is more of that. I mean, if we look at valuations now, all the AI levered names have done so well over the past 2 years, where very limited upside for multiples in Meta or in Google, given that they also have the search overhang, or even Amazon. Of the mega cap names that we cover, I think that Amazon has the best valuation on a growth adjusted basis, but it is more of that against the fundamentals. I think that there's a common belief that AI demand and AI is going nowhere, but given where the multiples are, perhaps we would have to see greater upward revisions on earnings before they get more credit on the share price.
Just to sort of underscore this point, Shweta, do you think that this is more an issue of just simply people jittery about valuations and maybe even the flow of money due to other considerations, and less about DeepSeek and a feeling that you really can do it with less?
I think so. I think that the knee-jerk reaction with DeepSeek and R1 model was that this is negative for the mega cap names, at least within internet. I'm going to refrain myself from talking about the impact on NVIDIA, but for the mega caps within our coverage. But as more commentary came out from all the CEOs, it is becoming increasingly clear that perhaps there is demand that is more to come. And all these companies are looking at R1 model under a microscope and will figure out a way to lower costs. So I think that is established that costs will likely come down for training and for inference, and against that there will be demand. I guess the question is, we now need to see accelerated path to returns on these investments, and until we see that, estimates likely won't go up, and until then they may not get full credit.
Shweta, appreciate it. Good to catch up with you. Shweta Kajuria there.
Thanks to
of Wolf Research. Thank you. Amazon is down by 3%. Constrained by capacity. Not a bad problem to have. Bad problem to have is when you've got too much capacity and not enough demand, and that's not where they are.
And yet it hasn't worked, because pretty much all of the main cloud computing service providers, all the main hyperscalers have said the same thing. The only reason why we didn't blow it out of the water was because of constraints. Still, Andy Jassy tried to do the good messaging. He said, we think virtually every application that we know of today is going to be reinvented with AI inside of it, really doubling down on the promise of this. Not enough.
It's a show me market for some of these names, that's for sure. Amazon is down by a little more than 3%. Broader equities just about unchanged on the S&P. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. The Israel Defense Force says its Air Force conducted a strike in Lebanese territory on 2 military sites. The IDF says the sites contain Hezbollah weapons, which is a violation of the ceasefire agreement. Meanwhile, Dallas Fed President Lori Logan has suggested that interest rates may already be near a neutral level, eliminating the need for further rate cuts even if inflation continues to cool, though she added the Fed would likely need to lower rates if the labor market deteriorated. And take a look at Porsche shares that are down in German trading. The luxury automaker says profits will slump this year. Costs are mounting after executives misjudged how eager sports car drivers would be to turn electric. Turns out they're not so eager, so Porsche is saying it will take a hit of as much as $830 million as it adds more combustion engine and hybrid models. That's your Bloomberg Brief. John?
Yahara, thank you. It's the sound of the engine.
I was just going to say
the engineering. You can't replicate that.
I mean,
right?
Honestly, do they really not understand their clientele? Do they really not understand
Seriously?
the people who want to drive up and be seen? I mean, they don't want to sort of seamlessly come in their Porsche. Come on.
Well said. Speak to Matt Miller next time.
Thank you.
Equity futures on the S&P, just about unchanged. Up next on the program, we're counting you down to payrolls.
If you asked any economist what the hardest month to forecast payrolls is, they would say January. We're going to see a little bit of this, pre-election uncertainty unwind. The actual Trump uncertainty, I think, will actually weigh on how much some of these gains can have going forward.
Up next on the program, we'll catch up with Sarah House of Wells Fargo, and we'll speak to Anna Wong of Bloomberg Economics. Live from New York, this is Bloomberg.
In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like Trump to change in terms of what some people see as the over-regulation of banking in America?
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of deregulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive internationally through a more benign environment.
Nobody covers Davos like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Treading water. How many times do we do this going into a payrolls report? Drops at 8:30, equities going nowhere. Euro dollar going nowhere. The bond market going nowhere. The 10-year Lisa 443.
I feel like, though, even though we've done a lot this week and we've worried about 15 different narratives, I kind of feel like it's been running in place, because are we really leaving this week with any more clarity or a feeling of direction? I'm just wondering, on a broader level in life, but I also wonder about markets.
You're getting philosophical. Is this a therapy session again?
It just feels exhausting without conclusive evidence that we are nearing some sort of measure of progress.
Which is why it's exhausting.
Yes, exactly.
Precisely why. Precisely why. The jobs report drops at 8:30 Eastern Time. Under surveillance this morning, we're counting you down to payrolls.
If you asked any economist what the hardest month to forecast payrolls is, they would say January. The last few Januaries, we've seen this very low layoff environment. And the low layoffs have really helped boost that January payrolls number. The past two payrolls, and including this one, I guess, we're going to see a little bit of this pre-election uncertainty unwind. The actual Trump uncertainty, I think, will actually weigh on how much some of these gains can have going forward.
So here's the latest this morning. Investors eyeing the payrolls report out in just under 2 hours' time. Economists expecting strong job growth and flat unemployment. Bloomberg's Anna Wong joins us now for more. Anna, welcome to the show. It's good to see you. Let's just get to why January is so difficult to forecast. What's special about the first month of the year?
Well, there's first thing, there's weather. And in the last couple Januaries, it's been unseasonably warm. And as a result, I still have the PTSD from the last two Januaries when we saw a gangbuster month of job prints. That's for one thing. And the second thing is a seasonal factor. So this year it's particularly difficult because we are expecting large downward revisions to jobs number throughout 2024. The benchmark revisions will likely reduce the non-seasonally adjusted employment level of March 2024 by about 700,000. And further out, there would also be about 200,000 downward revisions to the birth and death model. So all this will be changing how BLS estimate the seasonal factor. So I think the biggest component is the seasonal factors, which could, subtract or add about 50,000 from the consensus.
Which is the reason why Jonathan Pingle called this a random number generator yesterday, for a variety of reasons, but in part because of some of these trends that you're talking about. I want to talk about the revisions and how much that could shift the narrative for 2024, where a lot of people were worried about an overheating of the economy. How much do you think that we are going to reframe our knowledge of the 2024 jobs market after the revision that you're expecting of about a downward revision of about 700,000 jobs?
Right. So first of all, once you take into the seasonal adjustment, because the downward revisions happen to the non-seasonally adjusted numbers, once you factor in seasonal adjustment, I expect that it would show very close to negative or actual negative prints in September 2024 and October 2024. And it will be a very small, minor negative print. So in that sense, maybe it will, I don't think still that's enough to change the complete narrative that you did see improvement in the labor market maybe in the last couple months of 2024. There is some forward-looking implications, though, which is that if the BLS should downward revise the birth and death factor model, it means that in 2025, this year, for each payrolls, we're going to be seeing significantly less support from this artifact of the birth and death model. Because last year, the birth and death model contributed to 1.2 million jobs added out of 2 million jobs actually added. So a downward revision to that model has very significant forward-looking implications for future forecasts.
Anna, appreciate your input. Thank you. Anna Wong there of Bloomberg Economics. Lisa mentioned Jonathan Pingle of Natixis calling it the random number generator. I think we did that for him. Sonia Meskin of UBS came out and called it an exercise in predicting noise, right?
Because of the upward revisions, you are correct. You were the one that said basically that's the implication here. And so today that's what we're doing.
Don't want Jonathan getting a call from his boss, Why'd you call it that? It's important. 8:30 Eastern
Different
time.
Jonathan called it that.
Moves markets. Sarah House of Wells Fargo joins us now for more. Good save. Sarah, welcome to the program. The benchmark revisions, we just talked about them with our colleague Anna Wong. How big are you expecting those revisions to be?
Yeah, so we're looking for them to be in the ballpark of what the preliminary estimates show, which were around a negative 800,000 downward revision. But you have to remember these are applied to the period before March 2024. So the benchmark revisions are already close to a year in the rearview mirror. I think Anna was right in emphasizing what are some of the seasonal factors going to do, what's happening with the birth-death model in terms of what those downward revisions imply. So remember, the birth-death model is essentially the error that we see in terms of the survey. And so I think that does point to slower momentum that we had in the second half of 2024. But I think it will be interesting to see what's that more recent momentum the past few months. Do you see things picking up and still picking up in the fourth quarter after we get through these revisions?
Sarah, you noted that those revisions probably won't be enough to change the overall picture of solid hiring. Do you think that there is a higher bar right now for the number that we get from non-farm payrolls? The random number generator, as Jonathan Farrow said yesterday. Or do you think that just to basically show that we are seeing upside, that it's not going to wreck markets in any kind of capacity, but if we see downside, that could be really concerning?
Yeah, I think the general narrative has been that the U.S. economy and the labor market in particular has been much more resilient than I think most people anticipated. And so in some ways, I think an upside surprise would be less of a new development than if you were to see conditions weaken more than expected. So I do think the risks are somewhat asymmetric around what this print could be.
The Fed's Austin Goolsbee yesterday said you could overheat and you could deteriorate, but if you could freeze the job market just exactly where it is, that's not a bad spot to me. It looks like something approaching full employment. Do you agree?
Yeah, I think overall, when you look at the levels of the unemployment rate, the overall pace of hiring, we're still seeing them at a pretty healthy level. So yes, we've decelerated over the past year. It looks like last year even wasn't quite as strong as what's currently being reported. But with unemployment at 4.1%, that's smack dab in the Fed's central tendency for where they think this jobs market should be to eventually get consistent with their 2% inflation target. And so I think when we're looking at the absolute state of things, we're still doing okay, but there's still, I think, some concern as we head into 2025 with some of the policy uncertainty. I think some of the slide in demand that we've seen over the past 2.5 years, kind of where do things settle out? Do we stay where we are right now, or is there a further softening to go?
If there is further softening to go, what policy uncertainty are you most hoping to get more details about? Is it tariffs? Is it immigration?
So for the jobs market, I think the immigration story is